We've definitely been in somewhat of a rolling recession, but we could all agree we have not been in a labor market recession.
These kinds of numbers, you'd really have to question whether the economy is slowing down materially at all.
Underneath that surface, we are seeing some signs of concerns that make us worried about the sustainability of the jobs expansion.
To get inflation down to 2%, the only way to do that sustainably is have a big boom in productivity growth of 2 to 3%.
You don't have to have an economic collapse to get the inflation rate lower.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get your trading week started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P slightly negative after 9 weeks of gains on the S&P 500. We deliver a week of losses to kick off 2024. The next stop, TK CPI later this week. Then on to bank earnings on Friday.
Yeah, which is more important? The FT has that huge headline this morning talking about challenges to major U.S. banks coming up. So I'm going to put an extra weight there on bank earnings, the first shot from JP Morgan. But on inflation, I just think there's a massive mystery. What a joy to have Lori Calvasina coming up with us with some real later in 2024 optimism.
RBC's chief equity market strategist just around the corner. Bramo, I've read note after note after note asking one question. What can go wrong? Julian Emanuel of Evercore, nothing can go wrong optimism is at risk in the first half of 24.
And the risk, at least in the first week, was this idea that this over-optimism perhaps in Fed rate cuts that people were foreseeing. Friday was really interesting. The data was all over the place. We got a non-farm payrolls report that seemed to be good on its face. Then we got ISM services data that looked really weak on its face. And everyone went with the weakness, which means that they still have optimism in rate cuts that seems to be pervading a lot of the optimism in equities.
You're dead on. Michael Ferroli wrote at about 7 p.m. on Friday evening that he thought all in all it was constructive data. But I do take your point. I thought David Rosenberg was brilliant parsing out what Dr. Wong of Bloomberg, Anna Wong, was talking about, which is the birth-death adjustment. And you adjust to a huge number, like 400,000 jobs disappear for 2023.
Speaking of what can go wrong when you board a 737 MAX 9 jet? Boeing in the pre-market down and down hard. Lisa, can you imagine being on this Alaska Air flight over the weekend? Just brutal. The stock is lower by 9%.
I'm just grateful, I know a lot of people are, that nobody was sitting right next to this plug that they found in someone's backyard. It's a 63-pound thing that blew out. Here are the questions. Is this a manufacturing problem? Is this an actual product problem? How many MAX 737 MAX 9s are going to get sort of benched for the foreseeable future? But what does it say about Boeing's competitive advantage at a time where they're still in this heated battle with Airbus? Airbus shares up higher today.
And it's incremental. John and I were talking about this before we went to air, but you go back to Seattle, to Chicago, to somewhere outside Washington, and it's just been this thing, John, and that thing, the placement of the engines relative to the wing and on and on. Yet Airbus just seemed, and I could be wrong on this, we're going to talk to experts here on the show today, Airbus just continues to move forward, and there's a real distinction.
One of those experts coming up, George Ferguson of Bloomberg Intelligence, later this hour. Don't miss that. As we kick off your Monday morning, good morning. Here are the scores in financial markets, starting with the equity market on the S&P. We're negative again by 0.25%. Kicking off this week a little bit softer. Yields coming in almost a basis point, 4.0361%. But Lisa, I'm with you. On the surface of things, payrolls look pretty decent. Beneath the surface, some cracks. Then the ISM services came out, and the employment sub-index of that particular index was dreadful.
It fell the most into the lowest that we've seen going back to the heart of the pandemic in 2020. So here's the question. Will we get confirmation of the disinflation narrative on Thursday? And that really will be the key economic data point we do get this week. CPI coming in on Thursday. We have seen that steady decline. Do we see that continue given some of the pressures that people talk about that could reinflate later on? Of course, we also get PPI on Friday. Here's what I find interesting. We get a bunch of treasury auctions this week. I'm actually really focused on this at a time where the U.S. total public debt that's been trading in the system has doubled since 2014. Include 3-year notes tomorrow, $37 billion of 10-year notes on Wednesday, and 30-year notes, $21 billion of those on Thursday, and then corporate earnings on Friday. JP Morgan, as well as Bank of America and Delta. It should be kind of an interesting, diverse read. on where we are and how to go forward.
Lots of data, lots of earnings coming right up. Lisa, thank you. Starting the conversation this morning with Laurie Cavacina, the head of US equity strategy at RBC Capital Markets. Laurie, good morning to you. This line jumped out from your most recent note. The weak start in January is just the beginning of a phase of turbulence. How concerned are you about that?
Well, look, John, I was talking to one of my traders last week, and we were discussing the CFTC data we're starting to see that's really just looking very, very stretched. And I said, this looks scary. And I think we need to keep in mind that sentiment has been oscillating very, very quickly over the last 6 months. So this isn't necessarily something that has to derail a call for the year, maybe dampen enthusiasm just a little bit. But really what we've started to see the CFTC data on institutional investor positioning line up with what we're seeing on the retail survey for AAII. And both are looking very, very stretched right now. I think there are a number of things that could come in and trip this market up a bit, but usually it's something the market doesn't see coming. Right. So I think we need to focus here on the idea that sentiment itself just got carried away at the end of last year.
Laurie, Mike Wilson, who's been cautious on the markets over at Morgan Stanley, has a brilliant paragraph hearkening to nominal growth could be the surprise this year. It's one of his more optimistic constructions of where we're heading in the mystery of 2024. What do mid-caps and small caps do if we get legitimate animal spirit, we get legitimate nominal GDP?
So what we've typically seen is that when GDP, and we tend to look at it in real terms as opposed to nominal terms, but if you're looking at real GDP above 2.6%, and 2.6% has been the long-term average since the late 70s, we typically see that small caps and value stocks outperform in that environment. When GDP is running cool below trend, that's when large caps and growth tend to outperform. So it goes back to this question of leadership and rotation in the market. We've got GDP forecasts sitting at about 1.3% this year. That's up from about 1% back in November. So they're moving in the right direction. But if we really want to get a lasting, sustainable, durable leadership rotation away from the mega cap growth stocks and into basically everything else in the market, you need to see GDP expectations move up quite a bit more from where they are right now.
I mean, okay, well, the GDP's got to come up. I get that. But what do we do right now? I mean, are you deploying cash to small, they pulled back. Are you deploying cash this morning to small caps and mid caps?
So I still like them. I don't like them quite as much as I did, say 4 or 5 weeks ago when we last spoke. Right. One of the things we've seen is that in addition to sentiment getting a little frothy at the broader market, if you look at small cap positioning on the CFTC data, we're at an important crossroads. We're basically at the 3-year highs, but we're not at all-time highs. So we're going to know pretty soon whether or not small caps are really able to power through and take things up another leg. We're also still seeing that small caps look very cheap relative to large. But if you look at a Russell 2000 forward PE, it's back to average. Now, that's not usually where things top out at, but it is telling us that maybe we have made a lot of the easy money in small caps already. So do I like them? Yes. Do I like them as much as I did a month ago? Not quite.
This sounds all kind of negative, and yet you just upgraded your forecast for year-end 2024 to 51.50. That's a 10% upside from here. If it's not small caps, what leads?
So I think that the value stocks in particular are something to keep an eye on from here. We've seen the financials act quite well. Now I'm actually a little bit nervous about that heading into reporting season, but we've started to see some more favorable views emerge on the industrials as well. So I think we're going to get some interesting clues in this reporting season, but I do think sector composition is very, very tough right now. I do think, Lisa, if you kind of go back to our target, we were anticipating about a 10% return when we put that target out in mid-November. We were on sort of the earlier side of putting targets out. We trued up all of our, sort of models for year end. We did have this big ferocious run in December. And now where we're sitting today, even with this upgrade on the 5150, it's only about an 8% return on the year. So it's not necessarily getting more bullish. It's just kind of truing up our model for the year ahead based on the moves that we had in December.
You mentioned banks, and I find this interesting. How important is Friday going to be as JP Morgan kicks off earnings to give a sense of what the landscape is for banks, or is it just JP Morgan's world and everybody else is living in it?
So I think they all matter, Lisa. I don't think it's just any one particular bank. I know some get more attention than others, especially the ones that come at the beginning. But I tell you what I think is important for the banks is, one, are the sort of strong numbers that we've seen in terms of performance going to hold up? Sometimes we do see, sort of the banks give back when they've had a strong lead into reporting season. So are the numbers going to be good enough to really justify sustaining some of the better trends we've seen recently? I think that's one thing. But also, I think for someone like me who's not a specialist in the financials, we really go in and look at the financials for clues on the plumbing of the economy, on the health of the consumer. And I think that's probably going to be the most important thing coming out of the next, kind of week or so with those banks' earnings.
The real headline over the weekend coming into this morning, a positive surprise in Washington, D.C. Laurie, this story, congressional leaders announcing a deal on top-line spending for the current fiscal year. Laurie, I was speaking to Amy Wu Silverman in the last week, and we talked about your line, that talking about politics, the election this year specifically, is like staring at the sun. Is it that bad this year for you and the team?
Yeah, it's pretty awful, John. I mean, it's interesting. That line comes from my conversations with U.S.-based investors who are like, okay, it's time to write our outlooks. This is kind of thinking back the last month or so. What do we say about this? And we kind of walk people through data. We get through it quickly, and then we move on. European and Canadian investors, I mean, you could easily spend a whole meeting on this. It's like a spectator sport for them at this point. But I do think it's a major source of uncertainty. And I'll tell you what, it was interesting to me last week when I was working through some of the data we saw at the end of the year and the beginning of this year, is that you are starting to see money flows improve or turn positive to Japan, to emerging markets, to China, and to Europe. Right. U.S. flows are still holding up, but we are starting to see non-U.S. geographies really attract some better flows. And I think part of that has to do with the election based on what I'm hearing from the non-U.S. investors.
Laurie, answer a question for RBC clients watching, listening, which is, geez, we started the year weak, and that signals a terrible year ahead. Is there any validity to that emotion?
So I tend to be very skeptical of, these seasonal, kind of studies. Whenever we do this on this day, we do this for the rest of the week. I think that those kinds of studies can be massaged, frankly, change your starting point to show whatever you want to show. I've been actually looking at seasonality over the last 10 years. We've had some good ones. We've had some stinkers, but we have seen that January has been pretty much a mixed bag. There have been some difficult ones if you especially look over the last 5 years. So it would be sort of keeping with the recent seasonality to have a rough start to the year. Does that necessarily tell you that you have to run away for the rest of the year? I don't think so. And I go back to what we talked about at the top of the show. Sentiment has been oscillating so quickly. We were basically overbought in August, oversold in November, overbought in December again, and that all round tripped off of oversold conditions last October and post SVB. So I think that sentiment helps you tactically. I don't think you can use it that much to make a really kind of longer term view at this point.
Laurie, wonderful to get your views this morning. Thanks for being with us. Laurie Calvasina there of RBC Capital Markets, looking for 5150 year end on the S&P 500. That's the longer term story. In the near term, seeing reason for more turbulence from January and potentially beyond. We saw this from JP Morgan's Mislav Matejka this morning, Lisa. Stretch positioning, complacent sentiment. Not the only ones who think that.
And this seems to be sort of building on this idea that things got overbought in November and December, and that this is basically the hangover from that. Key question is, ultimately, it's going to come down to the economy. That's what Laurie Calvasina was saying, which is the reason why earnings are going to be important. And CPI is going to be important since the data that we got on Friday was kind of confusing.
And the politics, decent. Is that good news over the weekend? Who for?
Okay, I'm really skeptical. I have to be honest. I read this and I was thinking, okay, headline number. That's where the easy stuff happens, right?
Sure.
They can agree to $1.7 trillion. You look under the hood. Republicans, more fringe Republicans are criticizing this and saying that this is absolutely a non-starter. Democrats are coming out and saying, we're not concerned. I mean, this is where the details have to come into play. And the details are not always where the mess comes into play.
My take over the weekend was, and I'm looking at the SPX chart here on the Bloomberg. I do look at the Standard & Poor's 500, John, once a year. Coming out of 2022, it's up and away, and we've had a horrific correction of 1.6%. And the hysterics I find just fascinating. I don't have an opinion, bull, bear, whatever. That's not our job.
Sure.
But the level of hysterics on a dramatic 1.6% pullback, I'm just baffled.
We'll talk about the hysterics in Washington, D.C. in just a moment. Isaac Boltanski's going to join us shortly from BTIG. Remember when China seemingly lost its defense minister and everyone looked down their nose at China and disappearing ministers?
Oof.
What's happened to the defense secretary in the United States of America?
Elective surgery? Don't you want to know what it is?
Apparently we don't know.
No, we don't know when he's going to come back.
We'll try and find out. From New York City this morning, good morning.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
We've been negotiating in good faith all through the holidays, every day over the holidays, except for Christmas, on the top line numbers. Congress has a responsibility. We have the power of the purse, of course, and we have to be good stewards of precious taxpayer resources. We cannot continue to borrow money to spend it. And so reducing non-defense discretionary spending must be a priority of Congress.
That was House Speaker Mike Johnson on CBS yesterday, just hours before an announcement that a deal was reached on top-line spending in Congress, easing concerns of a looming U.S. government shutdown. That is some positive news this morning from New York City. Good morning. Here's the broader price action for you. Pulling back on the S&P 500, negative by just 0.1%. Yields lower by a single basis point, 4.0342% on a 10-year. The march towards CPI on Thursday, Tom, and earnings from JP Morgan and Bank of America this Friday.
Watching a real yield, 1.80%. Had a little bit higher real yield in the festivities last week. It'll be interesting to see off CPI where that is into those bank earnings. Right to it right now on Your Washington. Isaac Boltanski joins Director of Policy Research at BTIG. Isaac, I got to go with the lead headline, which is, I guess, all clear in Congress. We've actually passed a budget. Is that true?
Absolutely not. That couldn't be farther from the truth. Look, we now have top-line agreement on what we can spend for the fiscal year. That's great. It's wonderful. And that just means that the hard work gets to begin now. You know, I think there are 2 points to highlight. Number one is you've got to notice how angry the far right flank of the House GOP is this morning. We need to understand that the Speaker Johnson, is operating with no room for error, and he will almost certainly need Democratic support to pass his bill. That's something that former Speaker McCarthy didn't want to do, ended up doing, and then got thrown out from the speakership. And then number two is there are so many points of departure between Democrats and Republicans when it comes to the specifics of the spending agreement. There are upwards of 40 different poison pills some groups have counted that could shut down the talks around this. So, look, I think that the temperature has been taken down. The risk of a shutdown is slightly lower this morning, but there's still a lot of work that needs to be done over the next 11 days.
So what's the primary to-do list arcing over the next 11 days?
Yeah, so what I'm looking at is we have to get movement on the other issues around the spending bill. So it's good that we've got this, and now I think the appropriators will slink back into their offices, and you'll see some backroom negotiation and maybe not much on that. I'm interested in the border deal, Tom, because we've got to keep in mind the spending agreement is just part of this 3D chess game that we have going on. The other part is the supplemental spending measures. And here I'm talking about border security, and then, of course, funding for Taiwan, Ukraine, and Israel. That's the other part of it. And the lynch all of that is the border security deal that we're now expecting to come later this week.
You mentioned the international security concerns, big foreign policy issues. We've got to talk about the curious case of the missing defense secretary. Now, Isaac, first of all, we wish him all a speedy recovery. From what none of us seem to know, the details, according to our reporting, Lloyd Austin underwent an elective procedure in late December, didn't tell his staff they should notify others when he was admitted to Walter Reed Medical Center on New Year's Day after experiencing severe pain. At the same time, his chief of staff was ill with the flu and failed to notify anyone. The person said that we've been speaking to, according to our source, that Austin's military aide quickly put Deputy Secretary of Defense Kathleen Hicks in charge of running the Pentagon, although she wasn't informed of the reason for this decision. And the president, seemingly for days, didn't have a clue, Isaac, what was going on. What is going on?
This is one of the weirder stories you're going to come across in the Biden administration, which by and large has been pretty tame when it comes to these personnel stories, especially compared to the previous 4 years. But it's deeply unsettling, right? I know that the secretary is an incredibly incredibly private person, and that this is something that all of his staff have highlighted about him. But you don't get to be this private when you're sixth in line in the presidential line of succession. And so, look, this is deeply unsettling. especially given that transparency is one of the pillars of our political system. But ultimately, this too shall pass. And I think it just reminds you of some of the stories of personnel volatility that we saw during the Trump administration, which is going to be one of the campaign trail considerations as well.
You said volatility. Do you expect him to step down?
No, look, I think that depending on health, of course, that he is going to be fine. I mean, the president has not made any comment that suggests that the defense secretary will leave here. So I think he will stay. I wouldn't be surprised if he's replaced if President Biden does win re-election, though. I think this is the type of thing that doesn't get you reappointed.
Well, this raises a question, though, in general about foreign policy and also the platform for President Biden going forward. There were a list of asks that people are talking about his new platform, all of which are going to get rejected and are dead in the water. Is he going to basically be running on the anti-Trump candidacy once again at a time when Trump is consolidating a lot of popular support?
Yeah, look, I mean, there's obviously, you've heard that line 1,000 times that you campaign in poetry, but you govern in prose. I don't think anyone's going to like the poetry we see from the campaign trail this time around. It is truly going to be a fear-driven campaign. It is fear of the other side. It is fear of reversal. It is fear of retribution. I don't think that we're going to see much hope and excitement coming from the campaign trail over the next few months.
Isaac, you know the polarity of the states with Ohio and Ohio Wesleyan. I'm absolutely fascinating of the polarity in the Iowa caucuses. What is the distinctive tension as we begin the political season in Iowa?
I mean, look, presidential primaries are about retail politics, and they're about personal preference more so than any national poll could ever understand. And then when we think about Iowa, we've got to think about President Trump having a 32-point lead. And we've got to think about also, and I think this is important, Tom, DeSantis went all in on Iowa. This is it for him. And if he comes in second and loses by 30 points, which the polls are suggesting, pretty hard to imagine him being considered a serious contender going into New Hampshire, where he's clearly third, far behind Haley. And so really, this is, to me, Iowa is a litmus test for the DeSantis campaign. If he loses as badly as it looks, I think that his campaign, which has already been floundering, will effectively be over. And it's really a question then of how strongly Nikki Haley can look in New Hampshire a week later.
But to that point, Isaac, if he loses and he has to drop out, who does he back? Where do those votes go?
Look, I think it will be incredibly difficult for him to back anyone. I think that he will remain in the background. My bet, though, is that those votes actually split somewhat to Haley and the rest stay home for the primary. But my point to clients is Trump is going to be the nominee. That is very clear right now. He is the likely nominee. Those votes, when we're trying to figure out where they're going to him in the general election. And so that's the important point here. There's still so many clients and so many people in D.C. who don't want it to be Trump v. Biden. And I understand that. But all indications are it's Trump v. Biden. And that's what the market and D.C. folks need to start wrapping their heads around when we think about the politics and the policy of it all.
Isaac, thank you, sir. Isaac Boltanski there of BRTG. The politics and the policy. Then we've got to pick up on that point. Bramo, so much talk of politics, very little around policy. How many conversations have you heard in the last few months about what the next White House looks like and what kind of policies it's going to have?
Zero. And I was actually reading an article about what some of the policies are that Biden's putting forward, which is basically what was left on the cutting table from a lot of the Build Back America Better and all of these other types of programs, none of which are going to see the light of day, which raises this question, is it going to just be this dark, miserable campaign of anger and finger pointing and big catastrophic thoughts? I mean, that's basically what we heard from Isaac Boltanski, happy 2024. But that seems to be where we're at right now.
But that's American history. I think a reading of not all, but many campaigns is a huge bitterness. JFK, Nixon 60, going back to alien sedition, 1802, 1804. This is the normal process to see this kind of debate and anger.
This feels that normal to you?
This feels that normal to me.
Okay.
Yes.
Do you remember Libby Cantrell? She said her clients are asking her, but isn't it going to be Jamie Dimon or Oprah Winfrey? And she had to write, it's not going to be Jamie Dimon.
She wrote that.
That's kind of what Isaac was saying as well.
Yes.
Equity futures on the S&P slightly negative from New York City. This is Bloomberg. Stocks on the S&P 500 look a little something like this. Equity futures negative here. On the S&P, we're down by 0.16%. On the Nasdaq, down by 0.1. 9 weeks of gains on the S&P 500. It was the longest weekly winning streak going back to 2004. Last week, we snapped that. This from Mike Wilson of Morgan Stanley, asking the right questions. The question is whether this rally at year-end was simply a year-end short squeeze or a sign that the macro fundamentals are finally about to improve in a sustainable manner. At least the data on Friday did not speak to the latter.
Which is the reason why people are really looking to CPI. And we heard the same kind of talk from Lori Calvasino. What was interesting is that yet last week we saw the NASDAQ and the Russell 2000 both underperform. This idea that it's both rate cutting concerns as well as concerns about economic growth.
They pulled back for what? The first time in 9 weeks? They're allowed to pull back. It's normal. And to me, the hysteria right now about this is absolutely original. It's like we're addicted to up, and away in my beautiful balloon.
Am I being hysterical about this?
Not at all.
No, I didn't say you are.
Okay.
No, I'm not saying you are.
Sure.
The zeitgeist this weekend was, OMG, it's all over, we're all going to die. That was the zeitgeist this weekend.
That wasn't what I picked up on. But
really, what do you see? More
I just
optimism?
think people are asking what could go wrong after a massive run-up in stocks at year-end and over the last year. In fact, we've said it a few times. The fact that we've had the first weekly loss since October doesn't tell you how bad last week was. It tells you how great the last couple of months have been. Yeah. November, December, very powerful. Earnings the next stop for many of you I know. JP Morgan, Bank of America, coming this Friday. Looking at the bond market, 2-year, 10-year, 30-year, yields look like this, lower by a single basis point. A 10-year, 4.03% on a 10-year yield. The 2-year, 4.3746. Just this tug of war between payrolls looking good on the surface, Elisa, and then beneath the surface some cracks, and an ISM services read which was just not a great read at all.
And all these people who came out and said all the data has been really funky and you can't really trust a lot of it. So they're put this together, and that's the reason why people are looking to CPI to kind of clear things up. The trouble is, at tipping points,
was going to clear things
up. Exactly. But that's my point. You think that you get some clarity, but at tipping points you don't. And so how do you know which data, as you were asking last week, is going to be the important kind of guide to focus on?
Anna Wong of Bloomberg Economics, there was a drop in labour participation, more temp workers unable to find jobs, more people taking part-time work for economic reasons, a decline in working hours. Tom, they're the cracks beneath the surface of a headline payrolls number that was pretty decent.
There are cracks there, and a really important one is a run rate of GDP. There's some Atlanta GDP 2-ish going on out there, but a lot of other people are trying to a lower statistic.
Let's play a game. Foreign exchange, the euro. Guess what, Bramo?
109.
Unchanged. 109.43. There we go. Going absolutely nowhere. Let's leave that one
That's
there.
your foreign exchange report for the day.
Under surveillance this morning, Boeing sinking in pre-market trading as carriers around the world ground its 737 MAX 9 jet. US officials recovering parts and data after a panel blew off the fuselage of an Alaska Air flight on Friday. The jet was forced to land after a sudden decompression with 171 passengers on board. No one was injured. The good news is, Lisa, no one was sitting in that seat. It could have been very different on Friday night.
There could have been deaths. There had been deaths in previous accidents of this nature. Raises a lot of questions going forward, though, for Boeing, considering that they've had other issues. This was going back to 2019 with the MAX 8, right? This was the previous iteration that had some problems. So 2 questions. One, what's the issue going to be? Is it going to be a manufacturing problem, or is it going to be something structural that's going to ground all these planes indefinitely? And 2, how is Boeing going to remain a competitive, retain some sort of competitive advantage versus Airbus with this type of cloud hanging over?
This is somebody on the zeitgeist saying, am I going to fly a MAX this, a MAX that anymore? Are people now at the point where they're going to look at Google Flights, figure out the flight they're going to take, and go, what's the plane? And go, I'm not taking it. I don't know if we're there or not. We'll know in the next couple of days.
I do wonder how close we are to that moment with some of these Boeing incidents.
Yeah. I mean, I know the planes I love, and I try to take them, but I go the other way.
I just shut my eyes, try not to pay attention.
I think many people do the same thing.
I just can't deal.
Boeing this morning at the pre-market, for what it's worth, down almost 9%. We'll catch up with Bloomberg Intelligence in about 10 minutes on this story. Your next story, congressional leaders announcing a bipartisan deal, hoping to avoid a government shutdown. Senate Majority Leader Chuck Schumer and House Speaker Mike Johnson agreeing to $1.59 trillion spending cap for the fiscal year. Talks set to continue on Capitol Hill to fund federal agencies and avoid deadlines set for January 19th and Lisa February 2nd. So the good news, maybe the so-called relatively easy part is dealt with, but ultimately there's work to be done in Washington.
Here's the comment from the House Freedom Caucus. It's even worse than we thought. This is a total failure. So that's the starting point on the far right of the Republican Party.
Yeah, well, to me, it was Isaac Boltanski said, I went up with what we just saw on the board there on radio. We had upped the optimism of the spending cap. Boltanski said, forget about it. We got to get to January 19th, and it's a long way away. And he mentioned the border debate, which didn't go away this weekend.
Did you see the Michael Sembler's piece over at JP Morgan?
I missed that.
His year ahead outlook, just a fantastic piece if you can get hold of it. Within that, he talks about the trajectory of US debt, calls it a boiling frog. Every round of fiscal stimulus brings the US one step closer to debt unsustainability. I don't think we're there, otherwise we wouldn't recommend long-duration US government bonds. But we're accustomed to deteriorating US government finances with limited consequences, and one day that may change. This is the line for me, Lisa. By the early 2030s, the CBO projects that all federal government revenues will be consumed by entitlement payments and interest on the federal debt. And at some point between now and then, there may have to be a reckoning.
Especially because a lot of the debt that we have is short term. And if you look, it's doubled going back to 2014 with an accelerating clip. So how long can we keep this up at a time when no one's really willing to cut spending? And this, I think, is going to be a major underlying theme in this presidential election, at least for us.
Over in Congress as well. Right now, there's going to be a debate. Let's finish on this story, just absolutely bizarre. The Defense Secretary, Lloyd Austin, remains under hospital care, but facing criticism after failing to alert the president and the public of his condition. Secretary Austin was sent to Walter Reed with severe pains on Monday, January 1st, then sent to intensive care after complications from surgery. The White House reportedly not aware of Austin's condition until Thursday. The Pentagon not providing details on the exact procedure. Tom but saying he's recovering and is in good spirits. Now, I said it earlier, we wish him the best and a speedy recovery, but from what, we still don't really know.
I'm going to listen to the pros, and the pros are aghast, period. I mean, it doesn't matter. The politics has nothing to do with it. It's just a mess, a fumble by the Biden administration.
The president didn't know.
Yeah,
and seemingly the deputy to Lloyd Austin was seemingly
this
unaware
goes
as
back
well.
To I'm going to take it back to Woodrow Wilson, but I'm sure you can go back into the 19th century, and I don't know it. But the answer is we need communication here, and that was certainly a lack of it, to say the least. We get communication now in Frankfurt, Germany. Sonia Martin joins us now, head of disinflation policy at DZ Bank. I'm making a joke there, Sonia, about what's out there, and that is the descent of disinflation. From all the research that you have of DZ Bank, just to begin, is the European model, for that matter, the global model, is the glass half full?
Well, yes, I mean, certainly we have had our share of issues over the past few years, and, things here are looking pretty dire. I don't know if you saw in Germany today, we have massive strikes. The farmers are striking, they're blocking all the highways. We have a train strike coming up on Wednesday for at least 3 days. I mean, it's pretty chaotic here. Certainly in terms of our growth outlook, things aren't looking rosy. I mean, they might get a bit better than they were last year, but that's not saying much because that bar is hanging very, very low. In terms of inflation, it's coming down, but I've said to you before, I mean, that last mile is going to take a long time to cover. So things aren't looking fantastic over here.
I did a thing out on LinkedIn over the holiday, Sonia, which had to do with Europe and the former Prime Minister of Italy, Mr. Gentiloni. And the basic idea here is everyone feels we've sort of gotten clear of 8% unemployment. We've gotten clear of Eurosclerosis. What does DZ Bank say about that? You have a micro-analysis that's original. Is Germany, and frankly the rest of Europe, clear of the plague of decades ago?
I wouldn't say entirely, no. I mean, particularly when we think about debt freeze, I mean, one of the big issues that we've been having in Europe, and that, of course, caused a major crisis just over a decade ago. I mean, we're not clear of that at all. I mean, if anything, last year it's been spend, right? We've had all these crises, fiscal policy has been very loose. People have felt that they're justified in spending a lot of money. And I think the structural reforms that we so badly needed haven't necessarily been done. So I think that there is still a lot of underlying issues, and I don't think they're necessarily being tackled, if I'm honest.
Is the surprise of 2024 for Europe really going to come from China, and whether they can provide some stimulus and accelerate a little bit more than people expect?
if that were to happen, it would indeed be a surprise. It's not what we're expecting at all. I mean, China is looking very weak. They have a mountain of problems to deal with. And, with the debt levels that China has reached at this point, also a less and less ability to counteract economic weakness. I mean, the old method of just spend doesn't really work for China anymore. So they have to deal with all these issues. Obviously, the real estate sector is very hard hit. So we're not going to get a positive growth impulse from China this year. And this is one of the reasons why we're looking at still very moderate, weakish growth in Europe this year. There isn't really a source for a major acceleration of growth here.
Given that backdrop, is it plausible to you that the ECB can remain on hold and not cut rates as quickly as the Federal Reserve to really bolster this bet that we've seen on the euro versus the dollar to start the year?
Well, I mean, we all wish, I think, in a way that the ECB would be able to cut rates because, I mean, the rate level at this point is very restrictive. It's hurting consumers. It's hurting investment. It's hurting the real estate sector. I mean, it is causing considerable pain. And so from purely growth perspective, it would be very desirable for rates to come down. But the ECB has to look at inflation and core inflation, super core inflation, all of that still remains, very high. And so there isn't really, I think, any leeway.
Well, there's labor unrest, Sonia, in Germany. I think there's labor unrest going on in the United Kingdom as well. That speaks to me of persistent wage inflation, a theme in America. But is that a theme for DZ Bank this year, that we're just going to see a persistent wage inflation?
Well, I don't know what my wage increase is going to be this year, so I don't know if it's a topic for us at DZ Bank. But fact of the matter is, yes, we have had signs, and we've seen this last year, and we'll see this year. People are asking for more money, understandably, and this is what I mentioned before, that the underlying inflation pressures are still very much there, coming also from the labor market, and we have seen labor unrest, we have seen strikes going on, and this will continue. So again, for the ECB to now signal that it's time for rates to come down already, it's just too early and it's too risky, and it would mean that they might risk the progress they've already made on the inflation front. Even though, as I said, from an economic point of view, it would be desirable for rates to come down. I don't think the timing is right anytime soon, to be honest.
Sonia, just quickly, just to recap, favourite trade this year for you and the team, what is it?
I still think short dollar yen is a really attractive trade. I mean, I know things have been touchy now with the earthquake, but I think still the BOJ will have to move on policy, and I think short dollar yen is still a really attractive trade.
You've got a time horizon for that, Sonia, when they've got to move?
I think sooner rather than later, because the inflation rate in Japan is currently above the target. So the window's open now. It's going to come back towards target by the end of this year. So they can't wait too long. So I think by the middle of the year, they'll have to have moved.
Got it. Sonia, thank you. Great to catch up. Sonia Martin there of DZ Bank. Favourite trade? Short dollar yen. Looking for that stronger Japanese yen, Lisa, and looking maybe for a move from the BOJ before the middle of the year.
Wasn't that like a widowmaker during 2023? And now people are saying...
Just waiting.
waiting. And now people are saying no, but now they actually have to. And at least you have a bit more inflation and growth for them to really get behind in Japan.
The union activity in Europe, I'm fascinated by, because I think it's radically different than over here. It'll be interesting as 2024 unfolds to see what that wage growth or lack of wage growth does, really in both geographies.
Dollar yen, 144.45. That currency pair, pretty muted price action. That currency pair moving lower by 0.1%. One thing that isn't moving lower in a muted fashion is Boeing. Boeing is down by something like 8-9% this morning. Coming up on the programme, George Ferguson of Bloomberg Intelligence on the latest on Boeing TK with a stock down by more than 8%.
It's a huge deal. I think it's big. This is a much bigger deal than even has been played here. You're going to get into some reviews. Lisa's going to do team coverage out in Portland in a backyard. Can you imagine? You're sitting out there at the Barbie and that thing comes down.
Smartphones. It's raining iPhones, apparently.
Two of them, that they found them. I mean,
just not funny.
No.
Funny.
Imagine how much worse this could have been. Just absolutely insane. Stock is lower by a little more than 8%. The latest from Bloomberg Intelligence in just a moment. The broader price action on the S&P, we're negative by just 0.1%. From New York, this is Bloomberg.
Well, we look at Boeing's process for manufacturing this aircraft. At this stage of an investigation, everything's in. we go very broad. Nothing's excluded. It's pretty early on, but we don't exclude anything at this point of the investigation.
That was Jennifer Homendy there, the chair of the National Transportation Safety Board. Here's the latest. The FAA temporarily grounding the MAX 9 for safety checks after a fuselage section blew out during Alaska Airlines flight on Friday. Boeing CEO telling employees situations like this are a reminder that we must remain focused on continuing to improve every day. Fortunately, no one was seriously injured, and the course, Tom, still being investigated. The stock down by somewhere between 8 and 9%.
When in doubt, talk to an expert. Let's dive into that right now. On the Titanic, there were rivets, and the rivets failed. On a 747, there's maybe 1 million rivets. A 777, still the technology of ancient times of piecing metal together. Maybe 600,000 rivets, whatever it is. George Ferguson is expert on this, our senior aerospace, defense, and airline analyst on rivets and the lack thereof over the weekend. Was this a mechanical failure, George?
So I think this was a failure of fasteners. I think the fasteners were lacking, is my guess, is what we're going to find out. Obviously, I'm looking at this from 50,000 feet, but we're not finding plugs blowing out of other aircraft. We're not finding them blowing out of other Dash 9s. And so to me, when I look at, the piece that fell away, the cleanness of that, of what fell away from the airplane, it looks to me like someone on a production line didn't install all of the fasteners that needed to be installed to keep that panel in place.
Are the fasteners, I'm the amateur, I'm going to call them rivets, are the fasteners on that plane the same? Are they ubiquitous throughout all of Boeing and, for that matter, Airbus as well?
They're obviously going to come from a lot of different manufacturers, but I think they are going to be very, very similar. And again, I think this is probably a process issue. I think someone just didn't install the fasteners or didn't install all of them. And I think it probably leads back into Spirit Aerosystems, the manufacturer of the fuselage, which has had some problems.
George, let's talk about them. Spirit Aerosystems, for those in the audience that aren't familiar with that company, how do they fit in here? What's the broader story?
Yeah, so Spirit Aerosystems out of Wichita is makes the majority of the Boeing 737 fuselage. They make all of them. They were once part of Boeing, spun out a couple decades ago now. Spirit has had some challenges like the vertical stabilizer fastening issue, rear pressure bulkhead issues. There's been, I think, a lot of turnover at that company. With the pandemic, many people, I think, left aerospace thinking, why would I want to be in this business after they watch global air travel go to almost zero? And so I think the respooling up of that workforce has had, real major challenges at its Spirit. The U.S. job market is pretty hot. And I think, given the turnover, the training required in aerospace, the lack of, the big attention to detail, I think it's been really hard for Spirit to get things moving again down there. And I think that's what we're going to spend a lot of time looking at. We're concerned about the supplier base, but Spirit is sort of number one concern at Boeing.
Were they involved with the 2019 issues with the MAX 8 that Boeing also struggled with?
Sorry, you're not talking about MCAS, with the failure of the two crashes of the Boeing airplane.
The two crashes, yeah.
No, MCAS is more of a Boeing systems issue. They are very much just in the manufacturing portion of this business. But again, I'd come back to key to the Boeing recovery is going to be growth in production of 737 and deliveries of 737. We're starting to see that as the year ended in 2023. But Spirit is integral to that, to that effort, to that recovery. If Boeing doesn't get things stabilized down at Spirit, where Spirit is delivering quality fuselages all the time in the correct numbers, the recovery is going to be really hard to keep momentum behind.
Is this a cost issue, George? I mean, I guess that's what I'm going to. Is it that Spirit really is the cheapest option for Boeing, and that is the reason why Boeing is sticking with that company, regardless of a potential production flaw?
So no, there was an agreement written in when Spirit was spun out of Boeing that they would be the primary builder of the 737 fuselage while there was a 737. So I think it's really difficult to take it away from Spirit. Spirit probably isn't the lowest cost provider. There's probably some that are overseas. But again, I think the U.S. had some real challenges as we've gone through the pandemic. Workforce turnover has been large, I think probably larger than we've seen in the European aerospace industry. And that's been really hard to get, a handle around. I think Spirit management really has to get down there and double down on training and double down on oversight on the line, because to me, this appears like a problem that happened on that line. And we keep seeing these anomalies come through.
George, let's push forward. There are some airlines out there waiting for deliveries from Boeing and hoping for a ramp up in production. Given what's taken place going over the weekend, George, how likely is that anytime soon?
Well, I mean, obviously, we have to see how this investigation, evolves. To me, it does seem like an anomaly at this point. There's only 225 of these MAX 9s out there, so it's not a terribly difficult inspection process to take place. Most of them are in the U.S. Alaska and United are the majority. United's the majority. And so I think they could probably get their arms around this issue pretty quickly. I do think it'll lead to some delays. I don't think it's going to lead to significant delays at this point. I still think Boeing could probably hit the production they want to this year, if provided nothing else happens here.
George, what's the Airbus-Boeing distinction? I think the zeitgeist is Airbus has a lot of ergonomics. It's smoother, it's creamier in the cockpit, and Boeing has two engines moving forward. But for George Ferguson, what's the Airbus-Boeing distinction from an engineering standpoint?
So I think you are right. So some of the pilots I've talked to say the Airbus cockpit is probably a little bit more built around the pilot. We're built around the computer. Where Boeing perhaps is built a little bit more around the pilot and the pilot's skills. The zeitgeist right now, I don't know. I guess when I think about these two companies, Airbus is doing a much better job of executing. Airbus supply chain has challenges, but it appears that they are more on top of those challenges, and they're getting more quality, to their lines and through their lines, and that's allowing them to build more airplanes, and they're taking market share here. And so right now, Airbus looks like quality, Boeing looks like challenges. The real big challenge is if you're a fleet planner and you want an airplane, especially a narrow body, anytime soon, you could go get in the back of the line for the A320, which might be 6-7 years is pretty long, or you get in the back of the line of the Boeing line and be, I think, 4 or 5 years out. They had some backlogs. Some of these people in the backlogs the airlines aren't necessarily taking planes soon, but there's not a lot of other, sellers in town, if you will.
George, just quickly here, based on what you said, which is that this is a problem with the workforce and some of the disruptions from COVID, does that mean that post-COVID air travel is just a whole lot less safe?
I will say that we've had our challenges coming out of the pandemic because we brought the workforce. The workforce got depleted, and we had to rejuvenate the workforce. That's a challenge when you have new people in the industry learning their jobs. You're just not going to have the same level of safety, the same level of skill that you had, prior to the pandemic.
That's worrying. George, thank you, sir.
I still travel, though, so I still think it's a really safe system. But it is probably not as safe as it was pre-pandemic.
George Ferguson of Bloomberg Intelligence, thank you very much. Just to give you an update on where stocks are trading, Spirit Aerosystems, not to be confused with Spirit Airlines, is down by more than 18% in the pre-market. Boeing is down, Lisa, by more than 8%.
That's really alarming. It's not as safe as it was pre-pandemic.
Still safe, not as safe.
That's not really comforting. I used to get very nervous before I flew when I was a little kid, and all the stories are coming out now. Is if you're still very safe, you can fly, and they're coming out for a reason, given some of these accidents.
I got lucky. I was up in the fancy seats one time, and there was a lot of turbulence.
Just once.
I turned around, just once.
Every time.
And I turned around, and I looked back, and there was a woman on the ceiling of the airplane. And when I saw that, it was like, okay.
How many tangs in were you?
Yeah, I was deep into the tang. Seriously, though.
I'm not laughing about that. It's just where was this going?
I was on a flight once. I looked
turned
around
back,
and
there was a woman on the ceiling of the airplane.
Just flying.
Wear your seatbelt.
Amazing. Yeah.
Wear your seatbelt is the answer. I learned it the hard way.
Wear your seatbelt was the takeaway from that. Not maybe
she didn't wear
consume
a
less beverages on the plane.
She was on top of the airplane.
There was a woman
They cut me off after 4.
Elaine Becker at TD up a little later.
We've definitely been in somewhat of a rolling recession, but we could all agree we have not been in a labor market recession.
These kinds of numbers, you'd really have to question whether the economy is slowing down materially at all.
Underneath that surface, we are seeing some signs of concerns that make us worried about the sustainability of the jobs expansion.
To get inflation down to 2%, the only way to do that sustainably is have a big boom in productivity growth of 2 to 3%.
You don't have to have an economic collapse to get the inflation rate lower.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market just slightly negative on the S&P following the first weekly loss on the S&P 500 going back to October. 2 stops this week on the calendar. TK, CPI coming up on Thursday. Earnings for the big banks kicking off Friday.
Both hugely anticipated for different reasons. The banks, it's going to be a real measurement of the state of the economy. There's some gloom out there. Last time there was 2, and the banks deliver. But on the inflation side, I found it very mixed. I looked at ECO. First thing I did today was look at the ECO screen, and it's a jumble. I would call the inflation report coming out, John, a jumble this week.
The data so far more consistent with a soft landing than a recession, according to Mike Gapert of Bank of America. Ellen Zentner and Morgan Stanley. Lisa, we continue to project a soft landing for the labour market. Will the data we get this week speak to that?
That's really one of the big angst, especially as you talk about what can go wrong, right? What can break this idea after really messy data on Friday. I want to just emphasize this. The number of takes that I read on what the data from Friday, both the non-farm payrolls report as well as ISM services data, what that said about the economy ranged from, well, you got to trust the headline number to all this data is completely messy and you can't trust any of it. I mean, that was essentially the message that I got from all of the notes. They were each picking out their own little quadrant to really focus on.
What can go wrong? The answer to that, Standard Chartered, Eric Robertson. Sounds a little bit like Max Kettner here, TK. In our view, rate cut expectations are disappointed and the market has to price short end yields higher. That's what can go wrong.
Yeah, that's out there. And I think you to highlight Max Kettner last week of the changing tides that's out there from someone that was uber bullish over to some real caution here. But, and to get to Sharon Bell, who's going to come up in a moment here with Goldman Sachs, John, you devolved down from double-digit OMG, boy, NVIDIA went to the moon returns, down to good old all-American single-digit returns. How boring.
High single-digit returns over in Europe. That's what Goldman's looking for.
How boring.
Yeah, we'll take that, I think.
It's mundane.
It's pretty decent. It's mundane compared to the 24% gain we got on the S&P 500 last year.
On a Monday, it's mundane.
Okay, let's move on. The scores on the S&P look like this. Equity futures negative by 0.1%. If you want a single name, it's Boeing. It's tracking lower. It's negative by more than 8%. Lisa, more to come on that a little bit later.
And we'll hear about Tom Sojourns and why you should wear a seatbelt. Coming up, John mentioned the 2 major data points of the week. The first one being CPI coming on Thursday, the latest read on inflation, how much it really does drip back down to that soft landing, disinflationary narrative. I'm going to throw another narrative, though, into the mix. You talked about bank earnings, and I'll get to that in a second, but we also do have Treasury auctions, and we're talking a lot, John and Tom, about this question around the rising deficit and how much debt issuance there has been over the past few years. Just the outstanding public debt in the United States from the U.S. government has risen to $34 trillion from $14 trillion back in 2014. When you have 3-year, 10-year, and 30-year notes being auctioned this week, you get a read on how concerned people are over the longer-term look. To me, that's going to be telling. And then, of course, the corporate earnings. JP Morgan kicking off all of that on Friday. Bank of America also reporting that day, as well as Delta. Look at that. Over the past year, JP Morgan shares up 25%. Bank of America did nothing.
Wow, that's a great board, Lisa.
That's the disparity that we're talking about.
Treasuries, the distinction for that story.
Wow.
TK, just very, very different. Let's get to Sharon Bell, Senior European Equity Strategist at Goldman Sachs. Sharon, wonderful to hear from you. It's good to catch up to start a new year. Let's get straight into it. We've talked a lot about the dominance of US technology companies on the S&P 500 and beyond. Talked very little about Europe. Why are you and the team so constructive for the year ahead on the continent?
Well, I totally agree with what you said before. High single-digit returns would be great for Europe. And we had a good year last year. I think often that's overshadowed by the big tech stocks in the US doing so incredibly well. But Europe was up overall about 20% last year. That's a broad stock 600. But if you look at something more narrow like the Euro Stoxx 50, it beat the S&P in dollars. In total returns, it was up 27%. So actually, Europe had a great year last year, mainly driven by earnings too. So valuation is not that expensive. If you look at the PE for Europe, it's sort of about 12 and a half.
Right.
So it not expensive, reasonable earnings, good returns, not too bad a place to be.
Yeah, but Sharon, I'm fascinated by what people are doing. If I go back to the beginning of the panic, early January 2020, basically the U.S. has done a double off of Europe, up 11% or so versus up 6% on the stock 600. Okay, great. Now forward, are people in Europe, are Goldman Sachs clients in Europe insisting that they need to own American tech?
Oh, that's a good question. Look, I think that they, generally speaking, that what you can't get in Europe or you find much trickier to get is good, high, strong growth. What you can get in Europe is cheap valuations. You can get good dividend yields, you can get share buybacks, and you get some modest growth stocks as well. But really high growth is something that is just much more difficult to get in Europe. There are fewer listed companies like that. So there's always going to be a bid from Europe, from global investors, for big cap companies in the US, huge, big liquid companies that can give you that global reach, but also that growth. And the tech stocks often do that. The other criticism I'd have on Europe at the moment is it's more exposed to China than the US is. So a lot of the growth it has had in recent years has been China driven.
On an aggregate basis, or you can take it to the sector or nation you want to, what does the German slowdown, the overall German economic challenge have to stock 600 investment?
Yeah, I'm probably a little bit less worried about that than China, although it's kind of the same type of issue because it's sort of global trade growth coming down. China's domestic demand has weakened and that hits Germany. So it's all the same type of issue. Germany does have a big issue. I mean, it used to grow based on exporting to China and incredibly cheap energy that it was getting from Russia. And now neither of those things are in place. And then on top of that, obviously the autos industry, massive industry, both for the stock market and the economy, being hit by potential new entrants, being hit by that move to EV. So absolutely, I think Germany's got lots of problems. But it's actually, if you look at geographical sales exposure of European companies, sales exposure to Germany is not that big. The biggest place of sales exposure for European companies is actually the US. Much bigger, about 3 times the size of Germany in terms of importance for European companies. So yes, I think Germany is flatlining at best, probably in modest recession. But it doesn't matter, I think, as much for overall European demand as people think.
Especially if you're talking about Ozempic, or if you're talking about Airbus, or if you're talking about, an Hermes scarf. I mean, this is a question about if the Magnificent Seven of Europe look very different from the Magnificent Seven of the U.S. and are still the Magnificent whatever number in Europe that you can lean into. And I'm talking Novo Nordisk, Hermes, and to some degree, even Airbus.
No, totally. Or commodities companies. They're dependent on global demand. Or financials, which are dependent on interest rates, etc. So I think the sort of exposure to German cyclicality, it's not zero. I can't deny that. And Europe's more exposed to that than other regions. But other regions have their issues too. As I mentioned, China growth has been weak recently. Obviously, Asia overall is much more exposed to that than Europe is. So Europe's got its problems, but then it trades on 12 or 13 times PE. With the DAX trading even lower than that. So I think it's reasonably well priced too.
Sharon, you mentioned financials, and this has been sort of also one of the widowmakers, although last year it did pretty well with European banks. And I'm just wondering if the ECB is going to be cutting rates, is that a good thing or a bad thing for European financials?
Yeah, I mean, I was very convinced by European banks through last year, and we were overweight pretty much all last year. We downgraded right at the end of the year to a neutral. I wouldn't be negative about European banks. I very much see it as a neutral at the moment. I think rates clearly have peaked. We do expect to see the ECB cutting rates from April and then cutting quite consistently every quarter from there. The Bank of England as well, cutting rates from May. Those things are probably on balance, not so helpful for banks. But equally, we think economic growth will be okay. So you won't see a big rise in non-performing loans. I think that interest rates are going to be higher at the end of this cycle than they were at the end of last cycle with zero rates. So I don't feel the backdrop to banks is all that bad. And then final points on banks, they are also very cheap. They're buying back shares, they're paying extra dividends. So the returns you're getting on banks are often just by banks delivering you. They're very good cash flows at the moment.
Sharon, you mentioned where sales growth and sales would come from ultimately, geographically. Is there an underlying currency call that you're making alongside this equity call?
Yeah, it's interesting because, Europe often does quite well when the euro rises, which I know sounds odd because European companies are super globally exposed. So if the euro is rising, that should make it more tricky for them to do well. But actually, the euro rising is normally a good signal that global growth is strong, that Europe is not about to break up, that we aren't in a problem in terms of sovereigns. So we do have the euro rising. We have it rising to about 112. I think it's about 109 at the moment, 112 over this next year. So a modest rise in the euro. And we also have sterling rising to 135 over this next year. I think we're about 127 at the moment. So modest rise in European currencies. But to us, that reflects the fact that we think global growth will be okay. And we think that US interest rates are also peaking, and you'll start to see the Fed cut rates from March onwards. And all those things mean that it's a recipe for a slightly weaker dollar.
That's the ultimate call. Sharon, thank you. Good to catch up. Sharon Bow there of Goldman Sachs, looking for high single-digit gains for the Stock 600 TK European equities this year.
Yeah, I'd never done this. I go to MEMB. I looked at the European index and the Standard & Poor's 500, and boy, there it is in your face, the tech difference, the tech distinction of America. Novo Nordisk, that's the Ozempic thing, isn't it? Nestle, ASML, okay, that's techie. Novartis, Shell. Your LVMH, John, you're there daily.
Sure,
it's like
yeah.
number 10.
Yeah.
And the thing is just like completely different than the ginormous tech dominance.
What you heard there, though, Tom, was just a real constructive view on global growth.
Yes.
Really expressed in the FX market as well. So 109 at the moment on the euro, 127 on the pound against the dollar, and they're looking for 112 and 135, respectively, at least later this year.
Because of the growth that they see in the region, which will foster also better earnings calls. I will just say, she also mentioned the banking system. European banks had their best year ever versus U.S. banks last year. So this is the question about, moving to neutral, et cetera. What's more undervalued or overvalued at this point?
Yeah, hardly got talked about, Tom, because the banking system in America was really under the microscope.
Well, and let's be clear, we'll be under the microscope, including this week when we see JP Morgan.
JP Morgan on Friday, Bank of America as well. If you are just joining us, welcome to the programme. Equity futures just about unchanged on the S&P 500. Yields moving just a little bit higher by a single basis point, 4.0589%. The next stop for this bond market, CPI on Thursday. A lot of data this week. I think we get PPI on Friday as well, Tom. Will it continue to speak to that disinflationary trend which sets up rate cuts sooner rather than later?
There was just some really good work this weekend, and I look at the annualized, 3-month annualized, 6-month annualized, some of the compendiums of what you look at, and whichever way you play with the numbers, the fact is disinflation is in order. So my question is, A, how do you get flatness or a reversal to higher inflation? And what is that timeline? That to me is the mystery. If you get a Jim Bianco market, how long does it take to get there, to me, is complete mystery.
Jim Bianco coming right up. When you ask people what can go wrong this year, they'll talk about maybe repricing rates higher. You heard that from Max Kettner of HSBC just last week. You're hearing it from Eric Robertson of Standard Chartered over the weekend. Jim Bianco has a very similar view on all of that. Just repricing rates higher, again, could be the big risk for the year ahead. Jim Bianco in the next hour on Bloomberg TV and Radio. Coming up next, Bloomberg's Bobby Gosh on tensions in the Middle East. They have not gone anywhere. We'll talk about those tensions in just a moment. For the broader price action on the S&P 500, equity futures shaping up as follows. We are just about negative. Let's call it unchanged on the S&P 500. In the bond market, yields are just a little bit higher by a single basis point. The 10-year keeps hold of that 4 handle, 4.06% on a US 10-year yield. From New York, good morning.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
We reject the statements by some Israeli ministers and lawmakers calling for a resettlement of Palestinians outside of Gaza. These statements are irresponsible, they're inflammatory, and they only make it harder to secure a future of Palestinian-led Gaza, with Hamas no longer in control and with terrorist groups no longer able to threaten Israel's security.
That was Antony Blinken, the US Secretary of State, speaking from Qatar during the latest shuttle diplomacy tour of the Middle East and warning the conflict could easily spread. We'll pick up on that conversation in just a moment. If you are just joining us, broader price action looks a little something like this on the S&P 500, going absolutely nowhere. Yields are higher by a single basis point, 4.057%. Crude at various times last week threatened to break out. Tom, this morning breaking down by 3%, $71 and about 60 cents.
And again, we haven't said enough about this. With all the tension in the Eastern Mediterranean, I'm still thunderstruck where we are. And I guess the simple answer is the U.S. has brought on a lot of supply. I don't know if I buy that.
Keep going back to that number, Tom. 13 million plus, 13 million barrels a day of production in this country.
We're going to drive forward right now with a conversation on the Eastern Mediterranean. We're going to digress here at the beginning on the illnesses of Washington. Bobby Gush joins us now from Bloomberg Opinion as well. I go back to 1919. Woodrow Wilson has to get to 1921. He's blind in his left eye, and he's had some major strokes after a history of strokes going back into the late 19th century. Woodrow Wilson was fragile. We've set up an architecture of identification of ill people at the senior level. Should we be up in an uproar that the Secretary of Defense was ill over the last number of days?
We should be, and the White House should be. The fact that the Secretary of Defense was ill and hospitalized, and the President didn't know about it for 4 days, I beg your pardon. We're in a situation where there are two raging wars with strong U.S. interest, let's put it that way. ISIS is active again. There are crises after crises after crises, and the President of the United States didn't know that his Secretary of Defense was out of pocket. That there are protocols designed to prevent something like that from happening. Those protocols all broke down. Something more serious than a mealy-mouthed apology from the Defense Secretary.
The bipartisan uproar is going to be tangible, but I would suggest it will focus on 1600 Pennsylvania Avenue. What should be the response of the White House?
Well, the White House should demand something more substantive by way of an apology from the Secretary of Defense, and the President has to figure whether he's satisfied with the answer that he gets from the Secretary about why he was incommunicado for so long, or at least he was that the White House was not told. This seems like a very basic, simple mistake to make, and had this happened in any major corporation, heads would have rolled.
You know what I'm really curious about right now? There was a terrorist attack in Iran last week. What was the chain of communication between the White House and the Pentagon at that time? And shouldn't they have found out where the Defense Secretary was at that point?
They should have.
What happened? Did no one talk to each other when that happened?
Well, it would seem that the deputy was sort of responding to queries. We're being told that the secretary's assistant was themselves sort of in bed with the flu, and this is where all the communications broke down. That does not strike me as a satisfactory answer, that if one person has the flu, the president is kept in the dark. That can't be right, not in this day and age.
Which is the reason why there will be inquiries, no doubt, and still ongoing questions. There already has been outrage from both sides of the aisle in order to get more information. Bobby, I do wonder, though, you mentioned two raging wars. One of them, we started the segment with Tony Blinken talking in Qatar, where he said this is a moment of profound tension in the region. This is a conflict that could easily metastasize, causing even more insecurity and even more suffering. This morning, we're getting news of strikes by Israel against Hezbollah in Lebanon, more significant strikes. Is this the escalation that Tony Blinken was talking about?
Well, this is certainly a bigger step by the Israelis than, for instance, the assassination of the Hamas leader in in Beirut last week. This is a Hezbollah leader. When the Hamas leader was killed, Hezbollah had a degree of separation. They could, not that they did in public, but in private they could say, look, this is not our guy that was killed. We don't have to respond ferociously. When their own guy is killed, it would be much harder for them to justify anything short of a major response. This is the potential for escalation here, shall we say, is really, really great.
The role of some of the warships that the U.S. sent over to the Mediterranean, initially people were talking about this as trying to strike back or deter Hezbollah from attacking Israel. Is that the case, or is it to deter everyone from doing anything? What is the actual role of U.S. troops that are stationed in that region right now, with a debate raging in Washington, D.C. about what the U.S. role should be?
Well, the Biden administration doesn't want those ships to get involved in any fighting. They're there to deter, but when the deterrence fails, then what happens? You know, I'm reminded of there's an old in Broadway, in the theater, there's this old cliche that if there is a gun on the mantelpiece in the first act, then by the third act that gun has to be fired. That's what I worry about taking place here. The law of unintended consequences. If we've learned anything from the history of the United States in the Middle East, the law of the unintended consequences is not our friend.
We haven't spoken personally since the Maersk container shipping operation had to shut down again, can't go through the Red Sea, has to go through the southern tip of South Africa. Do you see that being resolved anytime soon? Is there anything that we can get a coalition together to do?
Well, we've warned, we have got a coalition together. There is a 10-nation flotilla of ships in the Red Sea. The Houthis have been issued with a warning, but they're disregarding the warning. So there's that question, well, what are you going to do next? You have issued an ultimatum. When the ultimatum is essentially waved aside, then what are you prepared to do? The shipping companies, I don't blame them for taking a zero-risk policy. They have, enormous amounts of money at stake. They have people at stake. They have ships at stake. I can understand why they don't want to go into those waters. I can see why the Houthis would keep firing off their missiles, because they have not paid a price. The question is, at what point do they have to pay a price?
When you were holding court in Iraq, we used to keep careful count of how many Americans were in Iraq. Ian Bremmer, in his top 10 risks for 2024, has a fabulous chart showing the many pockets of Americans across the Middle East. I was really caught by how many it sums up to. From where you sit, do we have a lot of American military in the Middle East?
We've got lots. We've always had. We've just re-upped our deal with Qatar to maintain the American base there. That may be the sort of most important piece of this sort of complex network of American bases and installations all over. We still have troops in Iraq, and they are coming under constant attack by militias that are associated with Iran. Just last week, we had the United States took out the leader of one of those militias. So it might seem that the Iraq war is way behind us in the rearview mirror, but the facts on the ground for the American soldiers who are there, not so much.
Bobby, thank you, sir, for the update. Your insight, always valuable. Bobby Ghosh there of Bloomberg Opinion. We've got to go back to the disappearing act of the Defense Secretary in the United States. Lisa, you can move on quickly from this. I get all of that, but it's not exactly like the global backdrop at the moment is quiet. It's anything but.
That's the issue. And I think that Bobby actually raised one of the key points, which is this White House going to hold the Secretary of Defense responsible for really violating a chain of command and really giving the White House a heads up when there is a material shift in leadership?
Several big events took place last week, Tom. And I'm just wondering who spoke to who. Was there no conversation between the White House and the Defense Secretary when those things were happening?
All that will be analyzed, and I agree it's a busy time when you're looking at defense, but far more than that is the heritage, the history of America across the 20th century. We have a constitutional amendment on this. We need healthy people at the top.
We are coming off the back of the first weekly loss on the S&P 500 since October. The bulls in this market have been absolutely spoiled for 2 months. We're kicking off 2024 with a week of losses. Your equity market this morning slightly negative on the S&P 500, down by 0.04%. The Nasdaq trying to bounce, trying to rally, up by not even 0.1%, up by 0.07. Turning to the bond market, 2-year, 10-year, 30-year, state of play right now, up a basis point or two at the front end to almost 440 on a 10-year, 4.06% on a US 10-year yield. We talked about that tug of war, Lisa, between the numbers we got on Friday. At the headline level, payrolls looked pretty decent, beneath the surface some cracks, and then literally 90 minutes later, we got the ISM services, and that didn't look good at all.
At a certain point, people were pricing in back to an 80% chance of a Fed rate cut in March after that ISM services data, after basically pricing it almost out, 50-50 chance just 90 minutes earlier. So here's the question. Which data do you trust? Is there a signal from the messiness of this that we are at a turning point, but we just don't know how far we are going to turn? That's the issue. Is this a more significant deterioration or just a slowdown?
It felt that way on Friday. We just don't know. TK, it really did feel that way. The 2-year yield, for instance, just to pick out one security, the front end of the bond market, that note, Tom, totally unchanged at the close on Friday after all of that information.
Yeah, I really take your point on that, John. I looked there at the close on Friday and saw the same thing as well. I just think people don't have a clue here. I mean, it's as basic as, do you clip the coupon or do you actually manage for total return this year after what we saw in 2023? That's a much tougher question.
Let's turn to foreign exchange and play. Guess where? The euro, Lisa, guess where?
109.
Unchanged. 109.41.
You guys are killing it. I'm telling you, the FX coverage on surveillance today, folks, is a value add.
Goldman was looking for 112, so that's something. You know, a couple of inches higher. They're cool on sterling, 135 and 127. Ultimately, they're looking for a better global backdrop, and off the back of that, a weaker dollar and stronger pound, stronger euro, I guess.
I love these exciting calls. 112. Woo!
Yeah, from 109.
Yeah, whoa.
50.
Crazy.
Basically where we are right now. Okay, enough of that. FX strategists everywhere furious with us now after that. Okay. When there is some price action, we'll bring it to you. Under surveillance this morning, Boeing shares tumbling as carriers around the world ground the company's 737 MAX 9 from service after a fuselage panel blew off on Alaska Airlines flight on Friday. US officials finding a key piece of evidence in their investigation, locating the fuselage panel in the backyard of a Portland-based teacher. Stock is down by 8%. The idea, just the very fact, the notion that no one was hurt after all of this, Lisa, is still just absolutely amazing.
A 63-pound plug fell from the sky into some guy's backyard. A teacher in Portland. Nobody got hurt. This thing blew off of a plane. Nobody was sitting in those seats. To your point, this is lucky. Yeah. But this is the point, at a certain point, where you have to really wonder what went wrong and how endemic is this to certain Boeing planes.
You know, the value add was George Ferguson with decades of experience, and he took it down to what he called fasteners. I called him rivets. If I'm United Airlines today, when the bar chart showed they have the most of these planes, whatever, if I'm United Airlines, you got to, maybe not today, but over the next week, check every damn fastener around every window on every plane.
Tightening all the fasteners.
I don't know what they do. I don't know the engineering aspect of this, but how can you do anything but that?
You mentioned United. There's a lot of airlines out there, Tom, waiting for deliveries from Boeing. There was a hope that they would ramp up production. Is that going to happen now after this? Go slow, go more carefully.
Nobody cares what my opinion is. You know, it's just wow. Just wow is all that can be said.
Stock is down 8%. Bramo cares. We all care, Tom. We care what you think. Let's finish on this. US congressional leaders announcing a deal on a top-line spending level for the current fiscal year, lessening the chances of a partial government shutdown later this week. The deal includes Democrat demands to spare immediate cuts to domestic agency budgets, but lacks an agreement to block all conservative policy riders, an issue which could still cause an impasse. I think it was a positive surprise because I wasn't expecting it to happen last night, Lisa, but ultimately, as most guests have told us already this morning, don't get too carried away here going into the middle of this month and beyond.
The Freedom Caucus already called it basically a disaster. They don't like it. You have Democrats who are just trying to stay quiet as the Republicans try to work themselves out. They're razor-thin majorities in terms of the House and the Senate. How do you get something passed? I mean, do we really work this through in less than 2 weeks?
You know, Isaac Boltanski was pretty grim. And the answer is, doesn't it come back to, the linkage of war funding with the migrant debate on the border? Period.
Well, let's get to that final story, Tom, on one of those foreign wars. Secretary of State Antony Blinken warning the Israel-Hamas war could, quote, easily turn into a broader Middle East conflict. Blinken looking to ease tensions in the latest trip to the area, making his remarks in Qatar ahead of more stops in the region.
Well,
This is a moment of profound tension in the region. This is a conflict that could easily metastasize, causing even more insecurity and even more suffering.
Lisa, Blinken set to travel to Saudi Arabia, Israel and the West Bank.
You wonder what exactly their relationship is right now with Israel at a time where Israel is attacking Hezbollah much more dramatically this morning. And this is something that we're watching as the Houthi militants also attacking ships. At a certain point, the U.S. can't not get involved because ships are getting rerouted and you have these sort of direct attacks on personnel in Iraq and other foreign bases. You start to wonder, okay, what's the tipping point here at a time when the government's mired in this pretty significantly?
And as someone said, where's the pushback? Where are we offensively going after people? I don't think we are right now.
We spent the last week trying to locate our defense secretary. I want to keep going back to it.
Yeah,
given how delicate the moment is, Tom, that story just sounds more and more bizarre.
Yeah, I agree. I agree. It's unraveling. If I'm the White House this morning, I agree. The tendency there is an unraveling of the illness of a Secretary of Defense. We're going to unravel to the bond market. Robert Tipp is Chief Investment Strategist at PGIM Fixed Income. I love, Robert, in your note where you say, everything considered, there is a strategic buy on bonds for 2024. What flavor of bills, notes, and bonds is the best strategic buy?
Well, most people's investment horizon, Tom, is long-term. And you ask whether this is going to be an alpha trading environment or a total return environment, and it's going to be both. That's what we saw last year. I think that's what we're going to see this year. At any given point in time, the market was up or down 5%. But by the time you got to the end of the year, it was up a handful of percentage points. Credit product had outperformed, and there was a lot of opportunity to make money in the zigzags in between. And I think that was the lesson from the Alaska Air. It's also applicable here in investments. You got to buckle up. You got to keep the seatbelt on tight and see what's going on out there. And right now, inflation is splashing down. You remember in the 1970s, it was a Twin Peaks. And the things that pushed inflation up the second time were rising energy prices, and part of that was a war. So, we're going into a thing that did not feature in the Fed's minutes last week, not one time, the word winter. We're heading into that. It's cold in Europe. If you have energy prices going up, if you have tensions in the Middle East, that's another formula for something that could get in the way of these expectations for rate cuts. I think that's something we could come back to again and again over the year. A lot of back and forth.
Are you barbelling, or are you just simply bringing duration in?
I think we're going to be, at given times, long and short. Right now, we've had a spectacular rally. People dashed into this market. They extended the expectations of rate cuts, which were an entirely plausible scenario, which could very well come to pass as we go through this year. So it could be justified. But we're seeing, as we suggested in the note, some consolidation here as investors second guess whether you really are going to get 2 percentage points of rate cuts. In the U.S., what we saw Friday in that payroll number is there's 0-second derivative on the trajectory of this economy for all practical purposes. In other words, not accelerating, not decelerating, growth straight through. So the Fed has a single variable that's going to drive that decision on whether they're cutting rates or not at this point, and that is inflation. Does it stay down as it has the last 6 months, in which case they can begin to slowly cut rates. Other places, it's more complicated. In Europe and the UK, they'll be looking at both growth and inflation.
You said something I want to pick up on, Robert. Are you basically looking to oil prices to determine whether to go long or short long-term bonds?
I think valuations are the critical thing here, and the risk factors. And when you get 200 basis points of cuts priced in, while the economy is growing just based on inflation being low, inflation can be very volatile. And the reality on the ground, as you cited there, is we have a situation in the Middle East. We're going into winter. Energy prices are volatile. And if that trend of the last 6 months changes, where we had below target inflation readings, that's going to slow down the Fed, because their motif of this cycle is don't do what they did in the 1970s, which was assume once you're coming down the first peak on inflation that the war was over. So I think that it's going to be a tactical environment here.
Yeah.
I think we're in the middle of the range right now, but the potential is there for moves in both directions.
What about the election, Robert? And I say this because we were just talking about the overhang of debt and how interest payments are going to take up a proportion of the overall budget that's enormous in the next couple of decades. How much are you watching this?
Yeah, well, that was the question people asked at the end of 2017. 2017 growth had moderated. People began to assume Trump would not get stimulus passed. And by the end of 2017, that all changed. Growth was rebounding. We had 2 stimulus packages passed. We had a surge in interest rates, just like we had at the end of 2016 when Trump won the election. So he's already marketing these extensions of tax cuts. That is going to be a very live issue as we go through this year, unless somehow that gets stomped out early on. But I think that's another real variable out there for the markets in this trading range, as the markets leap really from one guess on what's going to be the next big thing, either pushing rates up or down, making it a great trading market.
Robert, you're part of the market. You are part of the market. Is there a point at which you start to think, I don't want to buy treasuries because of this issue? Or do you wait for everyone else to start caring before you start caring? How does this work?
Yeah, well, I think that, number one, as Tom mentioned, the Fed is done raising rates for all practical purposes, as are the other major central banks. We put out our quarterly last week, as I put in there. We're past the peak in interest rates. Investors, as you can see, do not want to miss out this time like they did in the 80s. Once you had a big cycle, people wanted to wait for the next round of it. The Fed stamped that out as we rounded out the end of September, came into October. So I think this is going to be a market where you're going to earn the yield and you want to trade the range on duration, on curve shape, on spreads. But at the end of the day, when you look back 5 years from now, you're going to say, wow, this has been a great period in the bond market. And it all started when interest rates peaked back in 2023.
Robert Tipp, thank you, sir. Robert Tipp of PGIM Fixed Income. Lisa, just to think about that, how will you look at the bond market in 5 years, looking 5 years back? Was it that ultimate time to buy and lock it in, which essentially is the point Tipp is making, I guess?
And this is part of the reason why, if you look back in history, in the 3 months before the Fed started to cut rates in each subsequent cycle, every single time you saw yields come in, you saw bonds rally. So people are looking at history for that one.
If you are just joining us, welcome to the programme. Equities right now on the S&P, only slightly negative, no drama here. We're down by 0.1%. An update on the bond market, yields up by a single basis point, 4.06%. I mentioned this note from Michael Semblist of JP Morgan's private bank a little bit earlier this morning on the boiling frog that may well be the deficit issue in Washington, D.C. By the early 2030s, the CBO projects that all federal government revenues will be consumed by entitlement payments, Tom, and interest on the federal debt. 2030 is not that far away.
Yes, that's the key point. The timeline is not frightening, but the timeline is tangible. What I would point out, John, is every discussion of this with every adult, every pro, is a comparison of these debt glide paths with our growth glide path, and that growth glide path not there.
Coming up in the next hour, conversation continues. Claudia Sahm, former Fed economist and founder of Sahm Consulting. Look out for that conversation in about 45 minutes from now. The broader conversation is about a market that has been better than good for the last 2 months or so, but kicks off 2024 with a week of losses on the S&P 500, down another 0.1% from New York City. This is Bloomberg.
The question is, do we suspect that there is an overall design problem with this plane based on previous accidents involving the Boeing MAX? At this time, no. We are only focused on this investigation, this airplane. We are not focused on the fleet. But again, nothing is out.
That was Jennifer Homendy, the chair of the National Transportation Safety Board. The latest from the FAA, temporarily grounding the MAX 9 for safety checks after a fuselage section blew out during an Alaska Airlines flight on Friday. Alaska and United Airlines are the biggest operators of the MAX 9. Shares of the airlines following Boeing lower this morning. Alaska Air is down by almost 6%, Tom. Boeing easing the losses just a little bit in the last hour. We're still down by almost 8%.
And it wraps around the airline industry. I mean, Alaska Air happened to be the airline where this occurred. I don't hear people blaming Alaska Air for it. We'll see. But I just wonder what the airline business is heading for in 2000. You know, this shock is there and tangible, but they've had a lot of shocks and really struggled to rebound off of COVID.
You tell me how the consumer holds up, and I guess I'll answer that question for you.
I don't know. We're going to have to see. It's going to be absolutely fascinating when you have George Ferguson at Bloomberg Intelligence. That's a good place to start. We'll have continuing coverage of this. Brooke Sutherland for Bloomberg Opinion. Very, very good, particularly on Kansas manufacturing. Helene Becker joins now, Senior Research Analyst at TD Cowen. And we're thrilled that she could be with us today. Helene, January 22nd, I guess we get an earnings report from United. The others will line up. What is their urgency to act, not so much off the Boeing accident, but their urgency to act because of the topsy-turvy markets they're in?
Yeah, I think that we have a situation where we're expecting, or we saw fourth quarter traffic was pretty good. The further we get away from 2020, the more we'll see managed corporate travel come back. I think the trip where you have maybe a one-day trip isn't coming back anytime soon. I feel like it's a lot like after 9/11, Tom, when the really short-haul trips went away, and we expect that to continue really now. But the longer-haul trips, people need to get out. They need to see their clients. We've been talking about this for about a year now, and we're seeing that. We're seeing that increase in managed travel, and we think that will continue into the rest of this year.
With the Boeing accident, with the rivets, the fasteners, whatever we're going to see in the coming weeks of that analysis, even months, I should say, of that analysis, what does it mean for the dynamic of refleeting, a word I discovered last week? I think, Helene Becker, you know, refleeting is going out and buying the bright, shiny new thing. Is that accelerated?
Yeah, well, yes and no. American did their refleeting in the last decade, so they're on the downside of that. United is doing it now and into 2032. Delta is in the middle of it, but Delta has a different, and Southwest actually have different viewpoints on the way they refleet. They kind of spend about 10% revenue on CapEx, somewhere between 8 and 10%. Every year, so they're continually refleeting. So we view that fairly favorably. I don't think anything changes. There's a lot of pressure on the industry to lower their carbon footprint. I know aviation only makes up 2% of total transportation carbon, but others are doing the whole reduction carbon faster. So aviation over time will become a bigger percentage of it. So there's a lot of pressure to fly younger, more fuel-efficient aircraft.
Helene, I can't get past this comment from George Ferguson, words you never want to hear, when he basically came out and said it's not as safe as it was before the pandemic, talking about the safety of flying at a time when we did just have this incident with Alaska Airlines, also the incident that we saw in Japan, questions around the competency and staffing levels at some of the agencies. Are you concerned? Do you feel like that is an accurate statement, that it is not as safe to fly today as pre-pandemic?
No, I disagree with that completely. The fact that there were no casualties on the Japan Air A330 is hugely significant. They were able to evacuate that entire aircraft without any incident, with half the emergency doors being unusable because of fire. So I think that's one thing to consider. I think from an aviation perspective and a safety perspective, every time there's an incident, there's an investigation. There's no cover-up. You never see that as you may in some other industries. I I mean, not to jinx the industry, but there really haven't been any major accidents. The fact that Alaska Air's pilots were able to declare an emergency turnaround, land safely with no injuries is hugely significant. And I think aviation is still the safest form of transportation. No other industry does the deep dive into accidents that aviation does, and then aviation trains for every accident. And I think aviation is still very safe.
I think that a lot of people will point to what happened in Japan and point out that that plane that everyone did manage to get out of, I believe, was an Airbus and not a Boeing.
Yeah.
But nevertheless, So going forward, though, I am curious, what about some of the air traffic control issues and some of these other things? How important is it for airlines to do some sort of PR job, if nothing else, to assuage some of the concerns of neurotic people like myself, where you're looking at this and thinking like, I don't know?
Well, I think you have to think aviation is safe, number one. Number two, yes, we do need to address the air traffic control situation. And the fact that we now have a permanent administrator is hugely important. That's another thing that we view favorably. The FAA is certified to March 8th, so the government needs to really step up its efforts and get it certified permanently. My views are different than some of my peer group. I personally think the government should be responsible for safety and security. And I think air traffic control should be a separate corporation that's public, that's paid for everybody. Right now, General Aviation, Tom and Lisa and John, don't pay for using air traffic control system.
Helene, I wish we had another hour to cover this, because I think it's something each and every listener and viewer want to know about. Back to the Reagan uproar and unions of years ago, how different is our transportation safety structure versus other major developing countries?
Yeah, so Eurocontrol runs Europe, and that's a public company, and Nav Canada is a public company in Canada. It's just run differently, and I'm not saying it's better. I'm not saying it's worse. I'm just saying it's different, and you don't have the puts and starts that you have here. I've been talking about next gen since I started covering the industry 4 decades ago, and we're still talking about it. It's years behind schedule. It's over budget. Air traffic control, to your point, Tom, the Reagan administration fired all the air traffic controllers. They retrained them. NACA is the union that represents them. They're well trained, but they're overworked. They're fatigued. We don't have enough of them to handle what we're doing right now. And so the aviation system will slow down. You won't be able to. We'll see growth through replacing smaller aircraft with larger aircraft. We don't think we'll see the same level of pilot hiring in 24 and 25 that we saw in 21, 2, and 3. But from that perspective, as we move further into the decade and people have more experience, that will be beneficial. But we're not going to grow as fast as we grew in prior decades because we just don't have the experience. And we can't push the air traffic controllers to too much overtime because it's a very taxing job to begin with. And we don't want any accidents to occur in the U.S. Because we want to continue to be able to say it's the safest form of transportation.
Helene, I've got 60 seconds left on a clock. Top pick, favorite trade this year, what is it?
Oh, yeah, our favorite trade this year is Delta, after United was our favorite trade for the past 2 years.
Why the change?
The difference in CapEx, frankly, is the biggest difference. I think United will continue to do well, but they're going to borrow a lot of money. They have a $60 billion CapEx program between now and 2032, and Delta's is not nearly as big, so you won't see the stress in the balance sheet that you may see at United.
Interesting. Helene, thank you. Thanks for the update.
Thanks,
Helene Becker there of TD Cowen. Thank you very much. TK.
United, 72% debt. I didn't know that. She's great. Every time she's on, I'm just wowed by her history. 43 years ago, Reagan air traffic controllers.
I know.
Helene Becker was blistering there.
Bring up the stock board just quickly. You can see the clear underperformance of the airline that's more dependent on this particular jet that we're all discussing over the weekend. Lisa United, down by 1.4%.
And the others eking out gains as people look out toward the future, what kind of grounding this could actually look like.
More to come on this market. Big week ahead. Earnings on Friday from the big banks. CPI data coming on Thursday. Jim Bianco of Bianco Research up next.
When you look at where the Fed is right now, there really isn't that consensus for a March rate cut.
It's that the Fed that is going to cut this year. I think that's what's important, and that those cuts are likely to happen by around mid-year.
I do think the Fed is a little frustrated by the fact the market always must be more dovish than the Fed wants.
We're in this inflection point. The Fed has clearly done in terms of how much they're going to raise rates.
We're quite a long way away from that reconsideration of rate hikes, but it's not totally out of the realms of possibility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. After the jobs report, on to inflation. Forget about it. A world turned upside down in moments. James Bianco will join us, macro strategist, Bianco Research. John, if we get a Bianco market, all hell breaks loose. Yields go higher.
Looking forward to catching up with Jim on the risk of higher interest rates. We heard that from Standard Chartered. You heard that as well from HSBC last week. Let's start this morning with a question from Mike Wilson of Morgan Stanley. The question is whether this rally was simply a year-end short squeeze or a sign that the macro fundamentals are finally about to improve in a sustainable manner. Look, it's early days as we stumble out of the gate in 2024, but the data on Friday did not speak to that re-acceleration, that latter point of Mike Wilson.
I thought that Mike Wilson note was exceptionally acute this morning. He lays out 1, 2, 3 different scenarios that are out there, and there was huge uncertainty within the Wilson note. So I got to go back to earnings, and that begins this week with J.P. Morgan on Friday.
And Bank of America, and it's not about the numbers, it'll be about the forward look. It always is. Trying to get a forward look from the recent economic data, Tom. The services ISM on Friday. Payrolls gets all the headlines. The services ISM that came out 90 minutes later really whipsawed this market. If you go beneath the surface and look at the employment sub-index, Tom, the biggest contraction since 2020. So payrolls look great at the surface. Beneath the surface, some cracks. You go into the ISM, and in certain aspects of it, Tom, looked absolutely dreadful.
It really, at least it's a social overlay almost of the market. We're talking about fancy, economic macro babble. And the fact is, some of those statistics show in America flat on its back. There's just no other way to put it.
It's a complicated market. And you've mentioned this many times that we're in a pandemic economy, a post-pandemic economy with a lot of different cycles that are all kind of overlaid with one another. It's a complicated moment, which is the reason why Robert Tipp was talking about a trading range. It doesn't really lend itself to some sort of overriding thesis that can drive you through the year as much as trying to understand where the balance of risks are and what's getting priced into the market.
Or the data dependency here. I mean, to both of you, the basic idea to me is the arc here of what the earnings season will bring. And there's some tangible enthusiasm, Lisa, about earnings. And there's some legit enthusiasm that the gloom is too gloomy.
Well, some of the M&A can't go much lower, and certainly certain IPOs and things like that for the banking sector in particular, which kicks off the earnings season. This is really going to be the key point, and Lori Calvasina of RBC Capital Markets was talking about this earlier, that basically it's all going to come down to the earnings. Mike Wilson also. You have to see a reacceleration, or else this rally that we saw at the end of last year doesn't make sense.
I mean, looking, John, here, we've got some headlines coming out. John, I think these are important enough where we've got to cover them right now. And this is George Ferguson at Bloomberg Intelligence giving us wisdom on Spirit. They'll share further information on protocols with regulatory authorities. Spirit Aerosystems is really front and center in this burgeoning investigation.
Not to be confused with Spirit Airlines. So that's Spirit Aerosystems. Still looking for further information, Lisa. Boeing is down by something like 8% this morning.
This comes after they had other issues in 2019, crashes that did actually result in people getting injured, but people focusing on this to understand going forward. What does this mean for Boeing? What does this mean for airlines that depend on it, including United?
Well, we will have to see. It is our interview of the day, without question. Jim Bianco, President and Macro Strategist at Bianco Research, has really taken territories here to say disinflation is not in order. We'll see some form of leveling in inflation, and then perhaps an increased inflation, and with that, higher interest rates. He is with Bianco Research. Jim, the call is extraordinary, and now people are really beginning to pay attention. Put a when on it. What is the timeline you perceive to when we'll see the shock of higher interest rates?
Well, start with inflation. You could actually make the case that the year-over-year level of inflation bottomed in June when it hit 3.0%. It's at 3.1 now, and probably later this week when we get the December number, it'll probably go to 3.2 or 3.3. And that might be essentially it, that the inflation rate has found its low, or its last mile is here, or very close to here. And if it starts trending higher, I think then you'll start to see interest rates respond in kind, because what they've priced in is this idea that we're on our way to 2%. We're just quibbling about when we're going to get there, not if we're going to get there. And if we're starting to go the other way, I think that yields start going higher. Doesn't necessarily mean the Fed has to raise rates, but the idea that the market's got 5 rate cuts priced in, 6 last week, 5 now, that might be wildly optimistic.
When the price theory and the ambiguity of higher interest rates, does that come with better GDP or worse GDP?
No, I think it comes with better GDP, and I think that that's part of the issue here. 2023 is not quite in the record books yet. We haven't gotten the fourth quarter, but it looks like a 2.5% to 3% year. That's at least trend, if not above trend growth. We're looking at, if you believe the Atlanta Fed, and it's as good as any other measure, about a 2.5% fourth quarter after a 4.9% third quarter. So we slowed from the third to the fourth quarter from way above trend to probably trend or slightly above trend. So there is no soft landing in this economy right now. I mean, that's kind of wishful thinking. And the employment report on Friday really underscored that. It's not maybe an outright boom right now, but it certainly isn't a soft landing, and that will feed into it.
Jim, let's get into the data on Friday. Can I just jump in? Because it looks strong on the surface on a headline number, but going beneath the surface, this from Anna Wong of Bloomberg Economics, a drop in labour force participation, more people taking part-time work for economic reasons, a decline in working hours. The ISM was just dreadful. Are we not putting a lot of weight on the December data? How would you read some of that?
Well, 2 things. First of all, I think that we have to be careful with December and January. There's a lot of seasonal factors that come in at the end of the year that kind of skew those numbers a lot. Second of all, I think what we also have to look at is whether or not the nature of work has changed. I know I've been on here many times talking about we are in a remote work world right now where people go to the office 3 days a week, maybe 4 days a week, no longer 4 or 5 days a week. And that has changed a lot of things about the outlook for work and how we work. And really what we might be seeing in some of that data with like the increase of part-time jobs is the nature of work is changing as opposed to that it is a sign necessarily of weakness. You certainly don't see it in other numbers like the initial claims number in the low 200,000s. That's typically a number over the many years that we've been watching it is a number that is associated with a very strong labor economy.
So at this point, Jim, you were saying that yields could go up, you could go down, you could end up in this trading range. How important is CPI coming up on Thursday to really indicate whether this was just really noisy data that we got at the end of last week, or whether this was showing, particularly ISM services, some real weakness?
No, I think it's important because this month we should have maybe a small drag from gasoline prices. In November, there was a tremendous drop in gasoline prices, which is why the number was just 1/10. But now that we didn't have quite the drag on gasoline prices in December, we could get a true idea of what the underlying trend of inflation is without the noise of gas. And I think what we'll find is that underlying trend might be close to where we are on a year-over-year basis, somewhere around 3%. Remember, we're still at 4% year-over-year on core inflation as well.
John was mentioning earlier the budget deficit, and that's another kind of looming question hanging over just the inflation discussion in terms of where yields are going to be. And we were talking about this report. He mentioned JP Morgan, which showed that most of the tax revenues the U.S. brings in the next couple of decades are going to go to entitlements and to interest payments. That was based on an assumption that 10-year Treasury yields would be around 3.3%, or actually benchmark overnight rates would be 3.3% in 2033. Do you think that kind of projection is realistic, or do you think we are looking at a 4% world for the foreseeable future?
No, I think we're looking at higher rates. I think the 40-year bull market in bonds ended in 2020. We are in a trendingly higher environment for the next several years. Now, we could have a slowdown in the economy in a 2 or maybe a 3-year rally in the middle of it. But I think we got to start thinking about interest rates trending north as opposed to trending south. That ended, like I said, with the pandemic a couple of years ago. And as it does, we're going to see especially interest costs become a bigger problem. They just went over $1 trillion on a yearly basis that the government is going to be paying in interest, which is more than the Defense Department budget right now. And that's not going to get any better, at least in the next couple of years, because more debt's going to be rolling off at lower coupons and going to be reissued at higher coupons.
We've been talking about this now for the best part of a decade. You'd be the first to say, Jim, I'm sure, that we need a certain dose of humility around this particular topic. But the day of reckoning, just how far away is it, Jim? Surely you can't remain on this trajectory. What does that day of reckoning look like?
It looks a lot like what you saw, I should say now in 2022 in the UK with the gilts market and the LDI, the liability-driven investment problem. When the market decides that the day of reckoning is here, when the UK put out a budget that the market didn't like, it forced it to change. Well, the markets will do that too. So if we're going to keep borrowing debt and we're going to keep spending and we're going to keep running up, interest costs, at some point, it's not going to be a commission by the government that's going to fix it or a change in the leadership in the White House. It's going to be the market that's going to just put its foot down and say, enough, this is going to stop now, like it did in the UK in September of 2022. Now, whether that's next month or 10 years from now, that we could debate, but I do think it will be the market that will make that change.
Jim, the UK clearly didn't have the luxury of acting recklessly. Do you think the US does to any extent?
Well, it has because it's the reserve currency. And as long as it is the reserve currency, it is afforded a latitude that no other country is afforded because everybody else has to own our debt or own our currency because that's what trade is done in and that's what is the dominant currency that runs the world economy. But if we were to lose that status, and to be clear, I don't think we're about to lose that status anytime soon because there's a lack of an alternative, then yeah, that luxury will go away. But for now, we still have it, but we can't be abusing it because we're just going to force the day that it ends to come much sooner.
Huge numbers. Jim, great to catch up, sir. It's good to see you. Jim Bianco there.
Thank you.
Of Bianco Research on the possibility, the potential of resetting interest rates higher all over again. If you're just joining us, this is where rates are currently on a 10-year, higher by a single basis point, 4.057%. Just how close, TK, is that day of reckoning?
Oh, that's the whole thing, the x-axis here. But Bianco has just been way out front on this. He was early on it, notorious on it, if you will. But the continued call here for higher yields really pushes against the disinflation story. What's so important there, and I asked it because it's a John Riding question, is just, okay, you get higher rates. Oh, that's terrible. We're all going to die. And Bianco is crystal clear, a la John Riding, or maybe that's a sign of a more resilient American real GDP.
It's the way they go up, right? How many times have we heard this? That if they go up just a touch because of how strong the economy is, that's okay. But if the market puts its foot down, as Jim Bianco was saying, and as we saw certainly in the UK in 2022, then it just sort of brings to mind what James Carville said, right? When he gets reincarnated after he dies, he doesn't want to come back as a perfect baseball hitter. He wants to come back as the bond market. You can intimidate everyone. And that is the reason why people are watching to see when the bond market starts caring much more about this deficit.
It was intimidating for about 5 minutes, wasn't it? Last year, the month of October, Tom. Slightly intimidating and then backed away for a couple of months.
Yeah, I remember.
I think overall the Treasury market just bullied everyone through 2023, including the banks and various investors too.
I remember a point where I was stating this is the technical construction of the market in October, and it was grim, grim, grim. And a week later, if I'd had money in play, I would have been absolutely shellacked.
Part of this has to do with the Treasury Department responding to the bond market and issuing different kinds of debt. Can they keep doing that? That's going to be a real issue.
That's one of the.
If you had money in play, you would be shellacked. Okay.
Theoretically.
Henrietta Trey's of Vader Partners is coming up next. Your equity market is totally unchanged on the S&P 500 from New York City. Good morning.
We've been negotiating in good faith all through the holidays, every day over the holidays, except for Christmas, on the top line numbers. Congress has a responsibility. We have the power of the purse, of course, and we have to be good stewards of precious taxpayer resources. We cannot continue to borrow money to spend it. And so reducing non-defense discretionary spending must be a priority of Congress.
That was House Speaker Mike Johnson on CBS just yesterday. hours before an announcement that a deal was reached on top-line spending in Congress, easing concerns of a looming US government shutdown. Maybe just a little bit of a bright spot as Congress gets back to work. Your equity market more broadly this morning, and good morning to you, is totally unchanged on the S&P 500. Yields are going nowhere, got somewhere, I guess, up by almost a basis point, 4.05% on a 10-year. Real tug of war at the front end of the yield curve on Friday. We've talked lots about that already. Payrolls growth looks solid, the rest of it not so much. And then you look at the ISM Services Index that came out 90 minutes later, and that wasn't great at all. So the 2-year was totally unchanged by the end of trading, Tom, in Friday's session. This morning it's up by not even a basis point.
Take us back to that moment, folks, because this is 8:30 in the morning. Things look pretty good. We're looking at the revisions. It brings it down to 146. Anna Wong looks like a genius. And then, John, ISM comes out, 90 minutes later?
90 minutes later.
And it's, oops.
Well, you get all these sub-indexes, Tom, all these different reads. I'll go through some of it for you. So very close to stagnating in December. That's the overall read. Biggest drop going back to March, so the change was negative. Employment, biggest contraction since 2020. The gauge of unemployment in the low 40s. New orders index dropped to a 3-month low. You've got manufacturing earlier in the week has been in contraction since late 2022. Put it all together, Tom. Not great, but again, I think we all caution the same thing, the quirks of December. We'll see what the data looks like for this month and the next couple of months.
This is not Michigan confidence. This is countable data. Now, is it like weekly claims? No. Is it like other very countable statistics? But I'm going to suggest ISM is somewhat a countable idea.
It's survey data, but Tom, it goes completely against the grain. It goes completely against what we saw at the headline number in payrolls on Friday, which said everything's okay. That said something different.
Yeah. The euro's unchanged, 109.45.
Yeah, that's been the story of the morning, without a doubt.
The morning as well. What is the story? The story is your United States government, and we are thrilled to have in our studios Henrietta Trays, Director of Economic Policy Research at Veda Partners. We heard the Speaker of the House, verbatim, I mean, there's no other way to put it, verbatim, of Republican canon over decades and decades and decades. I want you to describe the distinction of the GOP hope to cut spending nominally or cut spending on an inflation-adjusted real basis. To me, the distinction is paramount.
I think that what we're looking at, the distinctions and the numbers between the House Freedom Caucus, the Speaker, and the new deal that they just reached over the weekend, and what Senate appropriators have done is so de minimis that to call this material deficit reduction is really kind of laughable to anybody who's, like Jim Bianco in your last segment, looking for earnest deficit reduction. That's not what we're talking about here. We're going to get a deal that basically has flatline funding, and then if you add on additional aid to Ukraine, Israel, et cetera, domestic supplementals, that's $55 billion the White House has requested. You're looking at fiscal year 24 spending that's above 23, no later.
Decades of this. I mean, I'm Ruth Perret now at Google. I mean, I remember being in a thing with her and Pete Peterson and a bunch of others. We've been talking about this for decades, and the distinction is the cutting of nominal or real spending. I mean, the British had an experience of real spending cuts a zillion years ago. Are we really going to do that? I don't see it.
No, there's no scenario where we're doing real cuts. The next best chance is if in 2025 you have a split House and Senate and White House. And the only scenario I see that happening is if Biden is the president and Republicans win the Senate and or the House. Then you have a massive tax bill that's due in 2025, and you can actually have a scenario where Democrats and Republicans are in a room negotiating $1 trillion, $2 trillion in tax changes, entitlement discussion, sort of the deficit commission, the super committee, that kind of stuff all over again in 2025. But you need to split Congress, and not this year.
What are you watching to understand whether this spending deal is actually making any progress versus a nice show of some progress that then just gets completely dashed as some of the details try to get worked out?
Well, this time around, Republicans, as you know, are having an even smaller majority. Math sort of remains undefeated, I guess. And when you're trying to count votes, you cannot get there for anything other than a Democrat plus Republican package, which means you're going to lose the far right. And it's up to Speaker Johnson to decide that he wants to barrel ahead. So my expectation is, despite this deal, you're probably going to get stopgap CRs that fund the federal government from January 19th to February 2nd. Maybe they lump them all together. And then we're doing that into March and again into April. The reality is we don't have a deadline until May 1st. And so they do not actually have to act until then. And I suspect we'll get a number of CRs despite the top line deal.
This is a massive week because we also are getting the Iowa sort of race heating up, heading into New Hampshire. And there's a real focus suddenly on 2024. Here we are and the election race. Do you think that the Lloyd Austin incident, where our Secretary of Defense went missing during a really serious period of time internationally, is going to make it into some of the discussion around re-election and platforms and what's going on at some of the top levels?
I think it'd be political malpractice for any of the Republicans not to mention it all day, every day. So as you go into the primary season, I suspect the Republican candidates will bring it up. I imagine that Trump is expected to be the front runner. That's my forecast for sure. He will bring it up for the remainder of the year. I don't see how that could be otherwise.
Can you help us understand what typically happens when there's a terrorist attack like the one that took place in Iran last Wednesday? Does the National Security Council reach out to the Pentagon? Where I'm struggling with this story, the disconnect for me, is why they didn't find out that the Defense Secretary was missing until Thursday, when these big things were happening. It gives me the impression, and I stress the impression, and I'm looking for some correction here if you've got it, gives me the impression that they don't talk to each other, even when bad things happen. Is there a correction there?
Not only are you not talking, but how are you telegraphing that you're not speaking? How are you not getting updated or providing some sort of press release even, or communication that, hey, here's where they are? You know, so apparently they all have them tracked and know precisely where they are if you're at that senior level. And there's
quite worrying, isn't it? This isn't just sort of a lapse in communication. It makes you think that they're not talking to each other.
It's unfathomable to think that they're not talking. So I think there needs to be some serious cleanup on aisle 2. And I suspect that we'll get that in the next couple of days. But the White House needs to step up the education on this one.
Yeah, TK, I'm really struggling with this story from over the weekend. Really struggling with it.
I think it's indicative of the administration. I think they got a lot to talk about here. It's not going to go away. And even on a Monday, it's evolving.
You think there's just too much on their plate? Would you agree with that?
I think it's maybe an indicator of the cavalier attitude they have towards going into 2025 and the election cycle as a whole. If I wanted to extrapolate, I would say, what does this mean about their ability to understand where voters are on the economy? Where does this stand with voters' understanding of how the state of the U.S. economy is? 70% of Americans think we're in either recession, stagnation, or deflation. I mean, the telegraphing, the education needs to be upped, no question, and their messaging team and their press team needs to hear that.
What are you looking for in the Iowa caucus to understand exactly how the Republicans are going to shift this forward and who number 2 is going to be behind the assumed head, which is going to be Donald Trump?
Yeah, I'd love for the primary season to be a real bellwether, but I think that any of the candidates that are not named Trump are really going to have to wait until the RNC, until the convention. I don't see an opportunity, absent some seismic blow up for Haley or something in New Hampshire or South Carolina, that upends all this, but none of the polling data is giving us that indication. So I suspect that we won't have any upset until this summer with the conventions, should something happen with trials or somebody's health or something like that.
Henrietta, I want to finish on this because you kind of alluded to it. Do you get the feeling there's some kind of institutional arrogance here? The lack of communication? Do they need, dare I say, a marketing division to come into the White House and figure things out? Because they always seem to be completely bemused by the disconnect of where they believe things are and where the electorate believes they are.
I mean, never underestimate a Democrat's ability to not send a message and not clarify it.
It's bizarre.
It's permanent. It's just always there.
What is that about?
God, I don't know. I wish it could be fixed.
I can't understand it, TK. I just cannot understand it.
I don't want to get into the political debate of it. That's not our place here at Bloomberg. But I will say it's indicative of many things we've seen from this administration.
Let me give you an example from the media
one.
side of things. So for the last 3 administrations that I've covered whilst being here, every time you have payrolls Friday, you get the NEC director come out and speak every Friday to all of the networks about how strong they think payrolls is. This administration handed it over to the Labour Department. Completely different approach with this admin, and just one of those small examples from within the media on the disconnect between the administration and the communication. Henrietta, thank you. Henrietta Trace of Vader Partners from New York. This is Bloomberg. 60 minutes away from the opening bell, 1 hour away this Monday morning. Good morning. Equity futures on the S&P just about turning positive in the last 10 minutes or so. Last week, a week of losses, the first week of losses going back to October. It has been better than good in this market. We were coming off the back of the longest weekly winning streak going back to 2004. We had 9 weeks of gains, then a week of losses to kick off 2024. Looking at equity futures right now, just about positive. On the Nasdaq 100 up by 0.2%. The Russell just a little bit lower by 0.1%. Just want to turn to the bond market quickly. 2-year, 10-year, 30-year. Looking at the front end of the curve, we talked about that tug of war all morning. Just that conflicting data. Headline payrolls looked pretty strong on Friday. And then you had this ISM services read where the employment index just didn't look great at all. The 2-year, actually, even after that payrolls number, we got at 8.30. 2-year finished totally unchanged almost in Friday's session. The 2-year this morning, 437.25. The next stop for this market is CPI data on Thursday. And Mike McKee is looking ahead to that and PPI on Friday. Mike, busy week.
Well, I'm saying that I own this chair on Thursday because it's CPI. The rest of the week, it's going to be Katie Greifeld and Eric Balchunas on the ETFs for Bitcoin. And Shonali is going to own the chair on Friday for all the bank earnings. But we do get CPI on Thursday. And it's going to be very interesting to see what happens because we're going to have the same situation as Europe did, where the headline CPI, in theory, is likely to go up because of base effects. There was a negative print in December of last year, which means that we're going to see a little bit of an increase this time. But core is going to go down. So which do the markets focus on? The immediate focus in Europe was on the headline number, but then the Europeans backed off of that. So do we get the same kind of analysis here?
What's a goods services dynamic right now? Like, I guess the vector of those two, but what's the distinction between goods and services movement right now? Well,
the interesting thing is we saw in the ISM report that John was just referencing for services that services prices went down. We've already seen goods prices going down some, and so it appears that both are on track to continue falling over a longer period, but we're not quite there yet. One of the big unknowns is what happens with this Red Sea shipping situation. A number of economists on Wall Street have dug into it and forecast, and they see in the United States almost no impact, about 0.1%, because shipping costs are very low, very small as a part of the overall price in the U.S. It'll be more in the Europe, maybe 0.3, but it all depends on how long it goes on.
We get a bunch of Fed speak this week as well, in addition to Treasury auctions, which is the reason why I found it interesting to hear from Dallas Fed President Lori Logan over the weekend. This question around asset purchases and whether they should start to slow or taper some of the quantitative tightening. How much are you starting to hear about that and expect to start hearing about that in the next couple of weeks?
Well, this is probably the first smoke on the horizon for that. And of course, coming from Lori Logan, it makes a lot of sense because she was head of the system open market at the New York Fed, and so she was in charge of all that. The question is, when do they get down to what they consider the minimum level of reserves, which will be above a minimum level? So they're going to have a sort of a built-in safety pad, and then do they start tapering it off? If you don't taper and you're lowering interest rates, you're working against yourself. So it probably makes sense to taper. So we'll hear more of that. The big Fed speaker this week is John Williams, because of course he's vice chair of the Open Market Committee. He's on Wednesday afternoon and he's giving a speech on the economic outlook. So everybody will try to read into that what the Fed's going to do.
Just to wrap things up, you mentioned sequencing. In the minutes themselves, did you get the impression they're starting to tee that up? Wind down QT before you start cutting rates?
Well, they get a Fed staff briefing. That's got to come first. They'll have another one probably at the next meeting, and you'll get a little bit more of a write-up of a discussion among them about it. They won't come out and say what they're going to do yet for a while, but maybe as we get towards the end of the first quarter, we'll see that. It was interesting. Lori Logan said we're likely to see the same problems that we had of a bit of a market seizure, because they really don't know where the ample level is. They try to figure it out. And I've always compared it to parallel parking a car in New York City, where you get into this very small space and you back up until you bump into the car behind you, and you go forward until you bump into the car behind you, back and forth. And that's kind of, I think, the way they'll
I'm
figure
not
it
sure
out.
that's what everyone does, Mike.
Thank you.
Maybe that's what Mike McKee's been
That's what
doing.
you do. There are other ways to do it. I'm just letting you know.
Mike, good to see you. Mike McKee, it's a busy one for Mike. On Thursday, CPI, that's the big data point of the week. TK, then on to Friday, we'll get PPI, some jobless claims in between.
And in between, we'll have a tour. It'll be at Ann Arbor, Michigan. It'll be floats and celebration of Michigan in football. And because of that, we were ordered to have a Michigan economist with us now. Claudia Sahm will be up all night watching a football game as well. Claudia, for the Department of Economics at Michigan, all that heritage, what does blue football actually mean? Do you completely ignore it, or are you at the 50-yard line for every game?
Well, they don't let the grad students have very good seats, but we went. It's Michigan. Go blue, right? Go blue. Oh, we'll see tonight. Thank you so much for joining. Claudia, Barry Ritholtz, you had a great idea out there that in our hysteria right now of single statistics, we have denominator blindness. Let's take the national debt, the interest expense of that, and we forget how large our economy is or how large our labor force is. How hysterical are we right now, and do we need to calm down?
Well, we've needed to calm down for decades. This is not a new conversation. The debt has to be put in context, not just of our GDP. That's a flow that we get that every year. We need to think about it in terms of, say, our wealth, which is multiples of what that debt is. And I'm also a firm believer, and we need to look under the hood and what are we spending our money on? There's good ways to do it, investment, R&D, and there's ways that aren't as good, maybe really high income tax cuts. So that's where we need to have the conversation, not just throwing around big numbers.
Is the Fed throwing around big numbers? Are they having a conversation as they move out into 2024 that you would consider appropriate and rational?
In terms of the debt or in terms of what they're going to do?
In terms of what they're going to do, their monetary policy, excuse me.
Yeah, no, I mean, the Fed is trying to do the impossible right now. My heart goes out to them, and we will play a parlor game for the next year or two and what their next move is. And yeah, they've got the eye on the prize, right? They work through financial markets, but they really don't care about financial markets. It's about getting inflation down. It's about keeping people with jobs. And we're well on our way, but it's going to be tough to know when they're there and can say, okay, we can back off.
Let's do an anatomy of what happened on Friday, because it was some confusing data that I tried to parse through and continue to, and read more reports, and I'm just as confused. Which data screams the truest to you at a time where we got a stronger than expected headline number, some real shows of strength, and then real signs of weakness, particularly in services employment?
Big picture, Friday's payrolls was a good day. Right, we had unemployment staying at 3.7%. We're averaging a little under 200,000 jobs in recent months. If you think about what the labor market is buffering, we have a 5 percentage point more than that increase in the federal funds rate. This is a strong labor market. Now, you can go under the hood. You can do this in almost any month and say, that doesn't look so good. Now, granted, there were some real signs, things to keep an eye on, and we always need to, but this was not a flashing red, we're going over the cliff. I mean, come on, the unemployment rate's been under 4% for the longest stretch since the 1960s. Well, that's good.
What about the services ISM data? The fact that hiring fell the most, the sort of sub-index for that particular data point came in the most going back to 2020 at the height of the pandemic. Does this make you feel like we're at a tipping point, even if we're not heading into the abyss, that we are cooling off in a much more material way?
It's been the case that last year we needed to rebalance. We needed to get to a place that was expansionary, but not red hot. I mean, we were coming out of a really bad labor market with COVID. So we do need to see things normalizing, slowing, not just this pace that's been so strong, because we want to get to a sustainable place. And there are going to be all signs. Frankly, I take a lot more out of the payrolls data than I do the ISM. We need to look at everything. And yet we've gotten a lot of mixed signals from the data, so far.
So readjust the SOM rule for us right now. How many states are in a miserable situation, Dr. Sahm?
So I haven't looked at every state recently. One that has stood out, and I imagine is still in the same place as California, that's a really good example of how you can have an industry that's having a tough time. I mean, tech in the Bay Area is legitimately having some tough times, and yet we have seen no signs of it spreading because it's an industry issue. It's not like a broad-based contraction. And I will say at the national level, the SOM rule went back down to 0.2 of a percentage point. So looking good so far.
Claudia, I just want to weigh in on some of the politics, and I don't want to bait you too much, but whenever I listen to you talk about the labour market, you offer clarity where clarity can be found, and where there isn't any, you leave the question open. It's really digestible, very, very intuitive. Why do you think this administration is struggling with the messaging so much around what's happening with this economy?
For a long time, Democrats have really put an emphasis on being the adult in the room. When I saw the jobs number, I had a GIF that I use. It's like, boom. It's like, come on, let's get excited about this. Yes, there's more to do. And yet when I look at all that has been accomplished in the last 4 years, and even during the Trump administration, the big push with CARES Act, we really help people. This is not perfect, but don't hide behind what you've done. Go out and say, we did a great job.
Okay, then why can't they do that? I mean, John brings up an incredibly important point, Claudia Sahm. You've been in the trenches. Why can't somebody just come out, not say, rosy morning in America and all that, but say, look, we understand the agonies out there, but boy, has this worked out from COVID versus many other countries and continents.
I really don't know. I mean, I have come across the fact that across the Democratic spectrum, there's just so much anger at each other. I mean, I've gotten the worst feedback from far left, and, center isn't exactly happy with me either. So it's so strange, right? But, I don't know. I hate politics. I really don't understand it. I just keep doing my work and trying to explain and trying to learn from what people are going through.
And we value your work. Claudia, thank you, as always. Just fantastic to hear from you. Claudia Sahm there of Sahm Consulting. Tom, on the data, the labour market, and just towards the end of that conversation on the struggles of messaging in Washington.
Claudia Sahm and others, studying under Ned Gramlich at Michigan years ago, would aggregate. That's what you do. And there's so many parts of American society where you're not going to aggregate right now. I brought it up a number of times. How can you be optimistic on the economy when you see the bankruptcy vectors that are out there right now? Just as one example. And then you've got, as she mentioned, the politics of it, far left, center, and for that matter, far right. But there's just a disaggregated sense out there right now.
I mean, honestly, I'm just looking at this and I'm thinking they got to get their message together, because right now the economic data looks pretty good. And yet, when you take a look at the polls...
Oh, dreadful.
I mean, that's the bottom line, is Biden is absolutely losing on the economy at a time where the economy just expanded at the fastest pace in years in the fourth quarter.
Just a massive disconnect, Tom. Massive disconnect between where the administration thinks things are and how people feel about the current situation.
The disconnect is a polarity of America. There's a large body that I'm sure is cheerleading on Republicans and Democrats about how good things are, but I would say all in all that's relatively narrow, or at least they don't have the voice in the sound box that many others have.
If you are just joining us, welcome to the programme. Equities just about turning positive on the S&P 500. Going into the opening bell, about 48 minutes away, we're positive by almost 0.1%. A little bit later on this morning, in the next segment, Barton Crockett of Rosenblatt Securities on tech. TK, conversation about tech stocks. Apple, for whatever it's worth, Apple having one of the worst weeks it's had going back to September last week. We got a downgrade from Barclays, another downgrade from Piper Sandler, just setting you up for that negativity quite early on in 2024.
Well, Barton Crockett's someone who speaks frankly. It'll be interesting what he has to say. Let's remember CES, which I've never been to. Lisa, have you been to CES?
No, I've never been there.
Tech extravaganza.
Ed
Ludlow's there.
He's there. Good.
They do new stuff. They're going to do the thing where you look around
virtual
like
reality.
This. Yeah, is that
Could I just point to one tech story? The Apple phones that fell out of the plane. One of them survived intact.
I saw that, yeah.
It fell 16,000 feet. Fell on the ground.
If you drop this now, 5 feet,
it's going to crack.
It's going to crack.
And I'm going to have to buy a new one, and I'm going to resent it.
What is that about?
I don't know, but this is shocking. I want to hear more about this phone. And
I'm guessing a sales rep went and put one there. I'm joking.
You are such a conspiracy monger.
It's a joke, Bramo. Futures on the S&P just about positive from New York City. This is Bloomberg.
the next 3 to 4 quarters, you're going to have iPhone growth. You have growth coming out of China, despite the fears and obviously a lot of the bear noise. And I think the most important thing is services. I mean, I think services is going to be teenager type of growth. That's key to the multiple expansion story. This is going to be viewed as more of a golden buying opportunity rather than the start to, hit the elevator exit.
That was the bullish view from Dan Ives of Wedbush on Apple and tech more broadly. The equity market had a week of losses last week. Apple responsible for at least some of that after a couple of downgrades from 2 key analysts that we'll get into in just a moment. To kick off this week, the second week of 2024, equity futures here, Lisa, positive by 0.04%.
Let's get into that right now. We saw more than a 5%, almost 6% decline in Apple over the past week. This is the first week to start the year. Microsoft down 2.2% and Amazon down 4.4%. Is this an Apple issue, given the fact that people are downgrading how much Apple can meet their price to earnings ratio versus the slowdown? Or is this something else that is broader tech? And that really is one of the key questions facing 2024.
A really tough start to the year. That stock down 5.9% last week. Growing concerns over the iPhone and sales, triggering 2 downgrades to start the week. In just the first week of the year, Barclays downgrading the stock to underweight from equal weight, and Piper Sandler cutting its price target 260 from 343. Rosenblatt Securities retaining its neutral rating on the tech chart. The analyst writes in this: we admire Apple's position as the maker of the world's most important device, the iPhone, but without disruptive new products, sales seem to be stuck in a muted place. Barton Crockett, senior research analyst at Rosenblatt Securities, joins us now for more. Barton, let's talk about that. The prospect of sales picking up for the iPhone and what's been holding them back over the last year.
Well, look, I think that, we downgraded Apple in early August. We currently have a $189 price target, neutral rating. And, our concern at that time is that you had a combination of a muted growth trajectory really across much of the company, including the iPhone, certainly factoring prominently into that, and a high valuation. So that combination in our mind was not compelling, not something you needed to be overweight on. I think the issue with the iPhone is the feature set innovation and the consumer pocketbook and some question about China. And I think all of those things have, given us data points that are very supportive of the notion that you're in a very muted place right now for iPhone. And I think given that that's something like 50% of sales, very difficult for that stock to have a lot of excitement, I think, if there's not a lot of excitement in the iPhone.
Barton, the basic idea here, I guess, for the bulls is they're running it for profit. If you look at the EBITDA margin from COVID 2019, they've moved from 29 cents on the dollar up to 33 cents on the dollar. Even if they get a Barton Crockett sales lassitude, can they maintain margins?
The company, I think, can maintain margins, but I don't know that that's type of story. Nickel and diming margins, muted growth is something that's going to be really compelling at currently about a 28 PE, 30 PE when we downgraded. I think certainly it's a great company. It's a good company that you could want to own at the appropriate price, but I think you've got to be price sensitive. I think it's a maturing company, and you can't buy it at any multiple, and you can't sit back and predict blue sky multiple expansion in perpetuity with this type of business as we see it right now.
I look at the center tendency of a long-term chart. When you say a pullback, how much would that be? If you do get some negative news out of China, et cetera, is this from 180 down to 160, which is the center distribution?
Certainly we would feel more comfortable with a healthy double-digit return to our price target. I do have some comfort with our estimates and with the street consensus. I do believe that, people have baked in the idea of a very muted iPhone. This is a company you can own at the right price, but it's a mature company price. It's not a growth multiple, I think.
Barton, is this an Apple problem or is this a big tech problem more broadly?
I think this is much more Apple. I mean, we look at some other big tech companies in our coverage, and we see a really great confluence of things developing. Lower interest rates, certainly supporting multiples expansion. certainly favoring scarce growth, which you don't have at Apple, but you do have at things like Amazon. And I think there's been a reset in the internet model. People have understood that you can run these businesses with much better margins, much more efficiently. So while you're nickel and diming some margin improvement at Apple, you're seeing explosive margin improvement at Amazon, at Meta, at Pinterest, at Spotify. Those I think are much more interesting opportunities in this environment.
Never thought that people would say Pinterest and Spotify would trump Apple when it came to potential opportunities. Is it negative enough, in your view, for them to really drop out of the Mag 7, for this to be defined by a very different narrative that Apple is just not included in 2024?
Well, Mag 7, certainly that's kind of, a term of art, I guess. The thing with Apple is I think it's a CPG company. I think that, it's a company that you like to own at the right price, in a certain macro environment where perhaps it's defensive. If the economy is slowing, maybe it's more interesting. But you don't need to be overweight Apple in every environment. You should pick and choose your places.
I always wonder what the appropriate multiple on that name actually is. You've got the core good, the iPhone going X growth. You've got a multiple that still looks pretty growthy as the revenue mix starts to shift towards services. Now, Barton, I'm wondering from your perspective, what multiple did you put on that business?
Well, look, I think that it's trading at about 1.4 times or so the market multiple. I think a lesser premium is appropriate. You can give it some premium given the strength of its franchise, the strength of its brand, the durability. The iPhone's not going away, and they've got good cash flow and good share repurchase. So to think that this could be a low to mid 20s multiple makes more sense to me than a 30 multiple.
Barton, thank you, sir, for your insight, the update to a new year. Barton Crockett there of Rosenblatt Securities on Apple with a real struggle to start the year. Pinterest. I wasn't expecting that either, Bramo. Still don't know what Pinterest do.
And Spotify. Well, that's because you're
every time we ask,
you're a guy. I think 15%.
Is that right?
15% of the audience, I think, is male,
is that
and
right?
85% is female.
Why
something
is that?
Like that. Because I don't know. I'm actually not on Pinterest, but I have heard from my friends who are actually avid Pinteresters that there is a good way of designing rooms and designing parties and
Men
designing.
Don't like having parties.
I don't. Evidently, I'm a woman and I don't know Pinterest at all, so I really don't know. But that's just the demographics.
Got it.
I'm really digging myself into a hole.
Tom's done some extensive research on this.
You
know that, don't
this
you?
one?
It's, TK will.
I interviewed
TK will.
Ben,
Thank you.
I interviewed Ben Silverman, I'll say 10, 12 years ago. I can't remember now. And I actually went out for like a week and looked at Pinterest like I was on TikTok for 3 hours or whatever. And it's exactly as you say. They attract a certain audience. Their audience has to be female, some would say more Midwest.
They have to be.
And they're doing this, and the other thing. And it's interesting how each of these social venues, and you could even say it about Apple, they have a culture, they have a character. And I don't know what to make of what Barton just said there about a real inherent, not caution, but just status quo technologically. I mean, what's the new? What's the next for Apple besides some silly vision thing?
I'll go back to what we said multiple times last week. That conversation we had with Barton, we could have had 1 million times over in 2023. The stock finished the year high by 48%. Even with all those things going on, none of that was new. That was the story of the last 12 months, and yet every single quarter we just seem to defy logic sometimes, Lisa, with that name.
Kind of like a phone falling 16,000 feet and surviving. Look, I do think that it's going to have to matter on the upgrading cycle and also on services. I mean, if you start to look at how much you're paying every month for various services that add on.
I've never done that.
I mean,
are you kidding me?
I know, right? It
like
starts to add up.
It's like, why do you need 4 movies today?
What goes on in your household?
I don't know.
I mean, don't you think the same thing?
I often wonder, but don't ask too many questions. Coming up on the Open in the next hour, Manus Cranny
that bill got laid
holding
in
down
the
the fort. Tony DeSpirito of BlackRock, Subhadra Japa of SocGen, Stuart Kaiser of Citi. Stuart out with his Sunday evening note. Not sure how many of you read that, but good news, Lisa. Certainly the view from Stuart over the last 12 months is good news.
And that is what he continues to say. I love that. Just stop it already. Good news is good news. But here's the thing. On Friday, was it good news or was it bad news?
Yeah, that would be the question I asked Stuart at 9:30.
That's exactly.
If I was sitting there, I'd be like, how would you read that?
Yeah.
Claudia Sam put more weight on payrolls at the headline and basically said you can always find some bad news beneath the surface, acknowledged there was some weakness there, and maybe discounted what we saw in the ISM services number. But that index, Friday, 10 a.m. Eastern time, wasn't great.
Well, let's go full circle to where we were at 6 a.m., and that is Michael Ferroli saying, it's single-digit low real GDP. It's not a recession. It's one-ish. maybe it's 2-ish, and that's what you get. And you get a single-digit equity return out of that.
Already in the swing of things for 2024, very quick.
Deep into
you just,
24.
hit the ground running.
So you're not going to say Happy New Year?
I'm not. I might to the Europeans because they've started their new year
Oh, come on.
this morning because they take their 3-week vacation. And they went back to work today. Did you notice that? I've got so many European friends that went back to work today.
And you're saying Happy New Year to them?
Yeah, my American friends are hard working. They've been going at it since, early January.
Stop.